lost some of that underlying momentum in the equity markets.
We're heading towards a seasonally weaker October.
It is getting more challenging as the valuations are getting tapped out.
We are relying on such a small cohort of names to drive this kind of upside.
There's as much melt-up risk as there is meltdown.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, we've seen this movie before. The nation's capital barreling towards a government shutdown as the divided Federal Reserve might have to wait for the next jobs report. Equities are looking to close out September with a fifth straight month of gains, and we're adding to those gains so far this morning.
Honestly, it's so funny to hear you talk about the government shutting down, all the geopolitical risk, the potential for the Fed chair yet again to get fired. And here we are potentially on the cusp of a September with the best return going back for a September in 2007. Look, we are looking at a market where seasonality has broken down, normal correlations have broken down. What's going to be the next driver up, given some of the skepticism that we heard, particularly last week, around the AI trade and how long that can power things forward?
I don't care about the politics.
Evidently.
Neither do you. I care about the data. My question for Annmarie, who's down in Washington, D.C., we'll catch up with her in about 15 minutes' time. Will we actually get the data on Friday of this government shutdown?
I was going to tell you this morning, welcome to ADP week. This is going to be not necessarily non-farm payrolls week. This is ADP week. When we get ADP numbers coming out on Wednesday, how much does that have the potential to disproportionately affect the market, especially if it does seem like there is a shutdown because of the uncertainty around Friday? This just highlights how much more every other data point is really going to make a difference.
ADP coming up later this week. Then it's the big one. I hope we get the big one on Friday. The estimate's 50K. The range anywhere between 105 at the high end. At the low end, something in a negative sign. A negative sign, maybe negative 20 on payrolls. 3-month average has dropped down from 200K at the start of the year down to 29. We want to see this story stabilise. We've certainly seen the rate story stabilise. Is the data story starting to stabilise too?
And what does it mean to stabilize? And I don't mean to be philosophical, but this is a clear debate on the Federal Reserve. Are we moving to a point where this is just naturally a low hire, low fire moment, where it is going to be naturally a lower number of jobs created in any given month? There are lots of questions around this. The absence of this data, how much does that increase the volatility in markets, especially given that this seems to be an inflation-insensitive Federal Reserve? They have made it clear, despite some hawks, I'm thinking of Cleveland Fed's Beth Hammack, you aren't seeing a lot of pushback around the idea that they are going to cut at least one more time this year.
They've picked a side. Protect employment. Despite the fact that inflation is closer to 3 than it is to 2, they've picked employment. The spread, though, and you've pointed out Beth Hammack, is still incredibly wide. And I think risk management, that phrase they used a few weeks ago, a risk management rate cut, I think that's just code for we can't agree on things right now. So let's just do a risk management rate cut and we'll work it out in a month's time.
Especially if everyone can agree on one thing, which is they are relatively far away from neutral. Maybe not that far away. Maybe some people are closer to 4. Maybe some people are closer to 3. Maybe, the Stephen Myrons of the world are closer to 2. Nonetheless, where we are now, 4.25% or 4%, that's already something that seems a little bit elevated, according to most people on the Fed.
We're back on track this morning, higher by 0.5%, adding to Friday's gains. The equity market is positive this morning. Coming up this hour, we'll catch up with Tony DeSpirito of BlackRock, with investors looking to extend Friday's gains. We'll talk to the former U.S. Congressman Patrick McHenry as a government shutdown looms over Washington, and we'll speak to Jim Bianco of Bianco Research, with the Fed's path looking even more uncertain. We begin this hour with stocks climbing to kick off a busy week full of economic data. Tony DeSpirito of BlackRock writing pocket of irrational exuberance and a trading environment dominated by non-fundamental investors create abundant opportunities for skilled stock pickers. Tony joins us now for more. Tony, good morning.
Good morning.
Good to see you. You mentioned that phrase, irrational exuberance, pockets of. Where do you see those pockets right now?
Yeah, so I was very careful to use the word pockets because I don't think that applies to the whole market. But I do see a market where, as I've discussed, the nature of the participants has changed. Fewer fundamental investors, more high-frequency traders, more retail investors. I think that helps fuel maybe some of those pockets. And then where I see the pockets are things like price-following strategies are doing very well. Unprofitable companies are doing very well. Some meme stocks. On the flip side, what's doing poorly? min vol's doing poorly, dividend payers are doing poorly, et cetera. And so that's where I see the pockets of irrational exuberance.
You've heard the phrase irrational exuberance before. We all have. It goes back to the mid-90s.
Yeah, sure.
And when it came out of Greenspan's mouth, there are still a few more years to go. The debate that we've had around this table a few times over the last month or so is whether it's the mid-90s or the late 90s. I think we've got to ask also whether that's even an appropriate benchmark to think about stock markets in 2025. How are you thinking about those themes?
Yes, so I think about it differently, which is I think about it in terms of, is it a good market to be a stock picker? And I hear some people complain about some of these pockets of rationality, but to be a good stock picker, you actually need mispricings, right? And so I really like a market where I see the pockets of mispricings. And so in terms of the market overall, I think we're on much sounder footing than we were in the late 90s.
How easy is it to pick stocks when they could potentially be whipped around by a truth?
Yeah, so well, I think the goal is you need pockets of irrationality, but you ultimately need rationality to prevail, right, for good stock picking. And I do think we have that market. And I think that there's a lot of activism in the market. There's a lot of buyout opportunities in the market. And so all those help bring stocks back to where they belong.
When you talk about stock picking, that makes me think that there isn't a lot of upside, or there isn't as clear of an upside in the overall market. Is that correct? That you don't necessarily see the sort of double-digit gains that we have been seeing for the past few years, and so right now it really depends on picking the winners and avoiding the losers?
Well, we've had, certainly the 2 prior years were big gains, over 20%. This year, above 10%, right? So we've had 3 really robust years in a row for market returns. Starting points matter. I do think we have to be realistic in our assumptions about where markets will take us from here. When you have a market that's at 23 times, I think you should have more muted expectations. It doesn't mean you should panic, but it just means you should have more muted expectations for returns going forward. 20% a year is not normal.
I remember that at the start of the year. It was the same conversation, and here we are, double-digit returns again.
Yes.
That's quite a return
so far. Well,
double-digit,
not 20%.
I'm with you, I'm with you. And it's not all multiple expansion, it's earnings too.
Yeah, sure.
Big
2/3 of it,
tech stocks.
2/3 of it, roughly, is earnings expansion. So earnings have done very well this year. The weaker dollar has helped. Particularly in the large cap space. But yeah, earnings have been robust, AI-driven, AI-related, plus a weaker dollar.
Some of those companies like NVIDIA, with a very powerful earnings story, have started to anchor other companies and make investments in them. There is this question as to whether that's just financial engineering or a sustainable anchor for a better future for this sector. Which side of that debate would you come down on?
Really neither. I mean, I kind of think about it as like this is a growing area. It's an area that's going to require a lot of capital. And NVIDIA has a lot of cash, for example, right? And so that's what I see happening. People with cash deploying their capital, investing in this wave.
I guess another way of spinning this is, where is the area you're seeing the greatest dislocation? Is it in tech or is it elsewhere?
Well, one of the things I find really interesting is that while there's a lot of enthusiasm in AI, and that's well-deserved, I think there are a number of companies where I see trough on trough. So I think about good compounding companies, but they're cyclically depressed, and the multiples have come down with that. As a value investor, those have historically been great investments. I think housing turnover is one of those areas. So the housing market's been incredibly weak. Actually, turnover is way worse than starts, right? Starts is modestly weak, but housing turnover is at like depressionary levels. If you measure housing turnover as a percent of the stock, which I think is the right way to do it, we're at levels that are basically at the early 1980s when interest rates were 20% and unemployment was 10%. So that's deeply depressed. You can buy some building material stocks at 12, 13 times current earnings, and current earnings are depressed. They should grow, if nothing else, they should grow 5% a year long term, but they should have a cyclical recovery on top of that. And so you're getting a really good business, cyclically depressed on the cheap.
This raises an interesting question. Neil Dutta over the weekend said, if you want the biggest argument against the U.S. reacceleration, take a look at the housing market. You can't have a housing market that's this flat on its back and have a reacceleration in the U.S. Is that a leading indicator or is that a lagging indicator, right? I mean, I guess that's my question to you. Can you bet on the upswing of turnover before rates come down, with rates higher this year than they were at the same time last year before all the interest rate cuts, and without a real material plan for how to revive this market?
Well, I think policymakers are really focused on this, right? Because this is what could create a lot of jobs growth. And so you see a lot. This is why policymakers are really trying to push on interest rates. Mortgage rates have come down. And if you think about like the embedded mortgage market, it's a bell curve, right? So you're eating away now at that bell curve. Now you're starting to see some refinancing pick up. You're going to start to see some more turnover as a result. There's talk about the administration declaring a housing emergency, for example, to try to stimulate housing. So there's a lot going on underneath the surface. It's hard to imagine it gets much worse than this, given that we're already at those early 1980s levels.
We keep going back to this issue. When the government talks about lower interest rates, they're very clear about what the objective is. It's lower borrowing costs, and they want to do something about this housing market. Now, if you want to bet against them, of course, go ahead. But ultimately, that's the goal of this administration.
The part of the problem is they keep talking about short end of the yield curve. They keep talking about the Fed cutting rates. But if you take a look at September through 2024, mortgage rates are about 33 basis points higher today than they were before the Fed cut by 125 basis points. So if that is the way that they're going to get down rates, it isn't affecting mortgages in the right way, which is part of the conundrum for so many people.
Since the Fed's meeting 2 weeks ago, bond yields have shifted just that little bit higher over the last 2 weeks. Tony, can we finish there? What is the relationship between the short rate story that Lisa's talking about and the housing market overall?
Yeah, so obviously mortgages price off the 10-year. The 10-year has started to come down, right, versus where it was earlier in the year. And then also the spread between mortgage rates and the 10-year is abnormally high right now. So there is some room there to bring things down.
Tony, good to see you. Thanks for dropping by. Thank you, sir. Tony DeSpirito there of BlackRock, kicking off our conversations for a brand new trading week. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump said the government is likely to shut down unless Democrats back down from their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The top 4 congressional leaders will meet with the president at the White House today, a day before funding is set to run out. Meanwhile, the president will be holding another key meeting at the White House today. He'll be talking with Israeli Prime Minister Benjamin Netanyahu. The meeting comes days after Netanyahu used the UN address to reject international demands for an end to the war in Gaza. Vice President J.D. Vance is expressing optimism a deal can be reached. And Team Europe has done it again, winning the 45th Ryder Cup, defeating the USA 15-13 at Bethpage Black here in New York. Europe built a substantial 7-point lead after the first 2 days, but the U.S. mounted a Sunday singles comeback that just came up short. Shane Lowry and Tyrrell Hatton sank crucial late putts to secure the emotional win for Team Europe. That's your Bloomberg Brief. John?
Nerve-wracking on Sunday afternoon when it really shouldn't have been that close. Dominant Friday and Saturday for Team Europe, and USA coming back really strong Sunday afternoon.
Yeah, Rory definitely coming back. All I can say is you took Friday off to really experience it more emotionally.
Is that where you think I was?
100%. You were there at the Ryder Cup, just experiencing this and preparing yourself.
I wish I was.
What's going to happen?
7 a.m. on Friday when Bryson tees off. The roar of that crowd, the atmosphere at Bethpage.
You were there.
I wish I was there.
You were there.
I was not there.
Yeah,
I wish I was there.
Why else did he take off?
All right. Up next on the program, avoiding a government shutdown.
Totally up to the Democrats. The ball is in their court. There is a bill sitting at the desk in the Senate right now. We could pick it up today and pass it.
We need a real negotiation, that you don't do this by one party putting together a completely partisan bill.
Up next on the program, we'll catch up with the former chair of the House Financial Services Committee, Patrick McHenry, live from New York City this morning. Good morning. Snapped a 3-day losing streak on Friday. The positive follow-through looks like this morning, up by 0.5% on the S&P, up by 0.6% on the Nasdaq. This from Brian Bowski of BMO. Take a listen to this. 7,000 might end up being too low for year-end on the S&P.
Yeah, we have, who are the biggest bull on Wall Street? 7,700, right? 7,700. And at what point are we going to look at other people kind of upgrading their outlooks? We're already at some of the outlooks that some people have for the end of 2026, and the AI trade just keeps on going.
With the Fed cutting interest rates, earnings solidifying, AI not anywhere near bubble territory, and the stock market performance broadening out. The believability, his word, and comfortability of US stocks is back in full swing. That's the feeling. I mean, we're going to catch up with Max Kettner later on this morning from HSBC, and he put out a titled note in the last week or so that was just up, and up. Seen a lot of that.
Yeah, well, I wonder if John Stoltzfus and Brian Belsky got in the same room and Max Kettner joined them. I think it'd be a little overwhelming for me because they would all be so exuberant about the potential valuations. Nobody can come up with a reason for this to really stop, except what happens if the Fed doesn't cut? What if we don't get data? What if the economy moves faster than we can really see?
We're hoping to get some data. We're hoping to get some data.
ADP.
This Friday, we're hoping to get payrolls. Under surveillance this morning, avoiding a government shutdown.
Totally up to the Democrats. The ball is in their court. There is a bill sitting at the desk in the Senate right now. We could pick it up today and pass it. That has been passed by the House, that will be signed into law by the president to keep the government open.
We've been resolute that we need a meeting, that we need a real negotiation, that you don't do this by one party putting together a completely partisan bill and saying take it or leave it.
Here's the latest this morning. Top congressional leaders on both sides will be meeting with President Donald Trump at the White House to discuss a short-term spending bill in an effort to avoid a government shutdown. With the latest and with a special guest, Annmarie joins us now for more. Hey, Annmarie.
Hey, John, good morning. We are looking like we are headed towards a government shutdown, even though the President of the United States will be sitting down in a bipartisan fashion with the top leaders from the House and the Senate. An individual who has been part of these conversations in the past, because we have been here before, is Patrick McHenry, former chair of the House Financial Services Committee. Former chairman, thank you so much for joining us this morning. Just going into this meeting this afternoon at the White House, do you think there is a chance of a breakthrough and this Congress can avoid a shutdown?
No, I don't have high hopes for this. I think it's unrealistic to think that the incentives will change by simply sitting down with President Trump. The incentive here right now is for congressional Democrats to find a way to fight. That is purely it. This is a mechanism for them to say that we are relevant. They're only relevant because they have the filibuster in the Senate, and Republicans do not have a filibuster-proof majority in the Senate. The continuing resolution, which is merely to keep the lights on in government for the next 6 weeks, passed the House. It now sits in the Senate. And the minority party in the Senate, the Democrats, have the say on whether or not the bill can be brought up, and they have blocked it last week. They are likely to block it this week. They need to show their base that they're fighting, and this is their way of doing it.
Could this have any pushback when it comes to the midterms on Republicans, given recent polling shows that when it comes to health care policy, which is the crux of the Democratic issue right now, when it comes to this extension of the government funding, that they actually get favorable numbers?
They do, but the rest of the issue set favors Republicans, from the economy to law enforcement to immigration. The field is tilted for Republicans on the policy front. The one silver lining for Democrats is health care, and this is what they want to highlight in the shutdown. The odd thing about a shutdown, and this shutdown that we're looking at right now has a lot of similarities to me of the 2013 shutdown, where congressional Republicans, I was part of the group. This is why it hurts me to see what Democrats are doing right now. We said we wanted President Obama to repeal his signature healthcare initiative, Obamacare. Very popular. Our stance was very popular with the American people. And in shutting down the government, we got nowhere on the policy. We got nowhere on furthering the belief that American people thought the Republicans were right. I think this is what we're going to face with Democratic leaders in the Senate and in the House. They're going to recognize this fight is not worth fighting. And in fact, a shutdown is in fact and continues to be a very dumb political lever here in Washington.
Well, in 2013, when they finally came to an agreement, there was a little bit of concessions when it came to the Affordable Care Act. Could we see concessions from Republicans and Democrats this time around to keep the government open?
Well, I think it's highly unlikely on the short-term government funding. On the longer-term one, which will take time to put together, I think you can see some modifications. And there's a lot of wiggle room when you're funding a a nearly $2 trillion government. And so I think there is an opportunity there. But for them to actually, for congressional Democrats to go into a shutdown strategy, this is their first time of trying this. What they're going to find is that this is not, it does not give them what they think it will get them. I think they're going to have to wait for further policy on a longer term spending bill. And they pulled this trigger at the wrong time.
How serious do you think the OMB is about when it comes to furloughs that usually happen during government shutdowns to actually making those job cuts permanent?
No, I think this is a plan the OMB director, Russ Vought, has been stewing for a long, long time. He's thought about this and thought about this and thought about it. And the White House strategy rests on OMB. OMB has enormous powers to carry out, especially in a shutdown, enormous powers over the executive branch and the functioning of the executive branch. And Russ Vought, the OMB director, has a plan. And I think it's going to be a very devastating one for Democrats. And they're going to rue the day that they actually gave Russ Vought this enhanced power. It's going to be fascinating to see what happens in the next week into the shutdown and for the weeks ahead, frankly.
A key question for financial markets as the shutdown looms is whether or not we're actually going to get economic data. We're supposed to get the non-farm payrolls report on Friday. If we're in a shutdown, will we get that report?
It's unlikely. It's unlikely we'll get that report. But this is also up to OMB. This is one of the things on whether or not it's deemed essential, the funding streams, or it's a complicated set of laws that OMB has the wide authority to implement. That's one that's an open question, frankly. But also our governmental statistics are an open question by the markets anyway. There's a lot of questioning of these statistics and the validity of them. And so, I think OMB may take the broader authorities than in previous shutdowns.
Former chair of the House Financial Services Committee, Patrick McHenry, thank you so much for your time and insight this morning, having lived through a number of shutdowns in the past. Jonathan, two big takeaways. You think shutdowns are dumb. I think a lot of Americans would agree with that. But also, we might not get that jobs report on Friday. President Trump would have to deem those individuals at the Bureau of Labor Statistics essential in order for that report to come down the pipe.
Annmarie, let's just acknowledge that fact. OK, we might not get payrolls. Apart from that, is there anything that this market investors need to pay attention to? They've been conditioned to ignore this repeatedly over years and years. Is it any different this time?
No, not at all. The market is just going to continuously ignore what's going on in Washington, D.C. This is going to be mostly purely political. The one thing the market is going to care about is whether or not we get the economic data. And that all depends on whether or not who they deem essential to the government continuously working and who basically gets to go home for a few weeks.
Let's hope we do. AMH, thank you. Annmarie with the latest down in Washington, D.C. More from Annmarie later on in the next hour. We'll catch up with the former senior U.S. intelligence official Norman Rule with the Gaza peace deal coming into focus. We'll get to that story in about 5-10 minutes' time. Bravo, for this market, just give me the data. You deal with the politics. This market does not want to confront the mess down in Washington, D.C. because it's seen this mess a million times.
So just to get some history in here, the longest shutdown of the U.S. government was back at the end of 2018, the start of 2019. It was 35 days. In 1996, we had one for 21 days. There was one in 2013 lasting 16 days. What is the threshold for people to care? Longer than just a few hours, and that could potentially be what it is. I do think that the prospect of mass job cuts in the government could potentially change the scenario. And that, I think, is what people are looking at for the possible economic ramification. But that's a stretch. And right now, the markets are moving on.
I mentioned Max Kantner of HSBC joins us later, just published. We still see clear signs of US and global growth reaccelerating in contrast to downbeat consensus expectations. I think it's fair to say that Max Kantner of HSBC is not paying much attention to the potential for a government shutdown.
I would just take issue with this idea of consensus being that gloomy.
Got the same question.
People might feel gloomy, but they're certainly not trading as though that's the case. He also talks about how potentially the biggest aspect that could derail this would be a surprisingly hawkish Fed, and it doesn't seem like that's in the docket either.
Yeah, we're pricing in a lot of earnings growth for 26.
Yeah.
It's hard to call that downbeat.
Exactly. I mean, it seems like the consensus.
Get Max's view a little bit later.
Thank you.
Plus, Danny Berger's got your morning movers. We'll catch up with Danny next. Alibaba rising on some bullish calls. That name is up 3.4%. Where did September go? October starts on Wednesday. This year's flying by. It's been 6 months since Liberation Day. Can you believe that?
No, I can't. And actually, it seems like it's been about 5 different years and distinct narratives. And I'm just so excited for the next couple of months.
Just absolutely wild. Looking forward to closing out the year, right?
Well, yeah, the end of the year, but also
3 more
just
months to go.
The wild ride that we're going to get in the next 3 months as well.
Q4 just around the corner. Futures look like this. On the S&P 500, positive by 0.6. On the Nasdaq 100, up by 0.7. Advancing going into the payrolls report that we hope we get this coming Friday. Into the bond market, we look like this. 2-year, 10-year, 30-year bond yields down across the board. We're down 2 on 2s, down 3 on 10s, 414 on 10s, 362 on 2s, and that whole curve just kind of grinding higher ever since the Fed met a few Wednesdays ago.
It has been led by the front end, which I think is interesting. And you still have this yield curve flattening going on, which is counter to what a lot of people were expecting. It does seem as though, especially given some of the hawkish rhetoric out of the Fed, but also the upside surprises and a number of different data points, people are saying maybe this Fed's going to be a little bit more concerned about inflation. And I have to say, the idea that the hawks are coming out swinging and that there are a number of them signals that maybe there's going to be more pushback to just cutting down to 2% like some people are
long
suggesting.
ends, it's super interesting, but the front end has got interesting too. Rate story stabilised. Fed speak is super divided. Data stabilised too, and I think that's really important about the future of that Fed debate, which is why, again, I want to see that data this coming Friday.
I think ISM manufacturing, JOLTS data, ADP data, jobless claims, all the data we're likely to get regardless of government shutdown are going to take on a disproportionate amount of meaning in a potential dark zone, at least for official data.
It is a week packed with economic data. If you switch at the board, I just want to finish on this story here in the commodity market. Crude down by 1.5% on Brent, on WTI down by 1.7%. If you wanted some comfort in the disinflationary story that the president and the White House is searching for, you might get it from OPEC at the moment. We're reporting here at Bloomberg they could be boosting production again in the next month or so. That's weighing on the commodity market this morning.
Yeah, and it comes after what we saw on Friday, which was a pop, Brent reaching the highest level since July, on concern that there would be a more hawkish policy when it comes to Ukraine and Russia, potentially strikes, allowing strikes after Russian assets, et cetera. So a real question here about how much OPEC is doing the heavy lifting to offset the geopolitics of the moment.
That's the cross-asset picture so far this Monday morning. Let's get you some single names, some stock movers, your morning movers with Danny Berger. Hey, Danny.
Hey, John. Occidental moving to the upside this morning, more than 1%. The FT reporting that they're looking at selling their OxyChem business. It's their petrochemical business for as much as $10 billion. Now, the FT reporters there didn't name the potential buyer, but a bit would be one of the biggest sell-off of one of their assets. And they've been doing so. They've been winding down a lot of their assets, looking to pay down debt. So that's the story with Occidental this morning. Meanwhile, the defense companies also moving higher. A story about an hour ago that the Pentagon has asked defense companies to double or even quadruple their missile output in some circumstances. They said they looked at the current stockpiles of U.S. weapons and deemed it far too low if there were to be a conflict with China. Off the back of that, you have Lockheed Martin up 2.5%, RTX up 2.3%. Of course, there's a question as to if they can actually put that output out as quickly and where the money would come from to do so. Finally, wrapping things up with Alibaba, the ADRs also to the upside this morning, 3.4%. A lot of analyst excitement. Specifically, Morningstar says fair value for the ADRs is 49% higher than it currently is, just given all the investment they're putting into AI data centers. That is a punchy number considering they've already doubled so far this year. John?
Danny, thank you. Appreciate it. More from Danny in the next hour. On our radar this morning, President Donald Trump once again turning to social media to escalate his long-running feud with Fed Chair Jay Powell, posting a cartoon on Truth Social that shows him delivering the famous line, "You're fired." I wonder what you thought about this over the weekend, because so many people just wanted to move on from this story and the president trolling the Fed chair once again.
Well, trolling is the key word. Do you take this as mandate? Do you take this as policy? Do you take this as the path of travel? Do you take this as just amping up the pressure? How do you understand this? What is the political analysis of a cartoon that says you're fired? I mean, it's this idea of at what point is this reality? At what point is this theatrics?
So we're kind of blessed in the sense that we can just follow the markets and their response and reaction to these kind of things and don't have to provide our opinion to any of this stuff. If you are worried about central bank independence, the first place you should look is inflation expectations. And there is very little sign, if any, that market-based inflation expectations have become unmoored, unanchored. You don't see that. So I would say this market at the moment, doesn't really care.
This is the reason why Fed Chair Jay Powell has not been fired and why they have yet to announce who his successor is going to be. Because you can keep raising the specter of a boogeyman, of someone who is not doing their job right, at the same time that you might be getting data that isn't perfect or that might be a little bit lumpy. So it comes with this interesting moment where it's raising the pressure to one constituent. The market's not listening. Perfect. You don't want the market to listen. And it serves a lot of different purposes. And that is how I read this exactly. Because ultimately, people have noticed, hey, guess what? We haven't gotten another Fed chair successor or nominee. That would have undermined Chair Powell's credibility and the narrative. They haven't done that yet, even though they could have. And that, I think, tells you everything you need to know.
Maybe the market's got a sense of humour. I don't know. If you told me 12 months ago that this would be something that happened over the weekend and we'd wake up Monday morning with bond yields lower, stocks higher by 0.5%, just shrug it off and ignore it.
Yeah.
I'd be surprised by that 12 months ago. I'm not surprised now.
Yeah, well, I don't think the bond traders looking at that being like, ha ha, that's a knee slapper. But I do think that people are saying we can't really take signal from this. This is just reiterating the rhetoric we've heard before.
That's the latest on the Federal Reserve. I wanted to turn to this as well, the latest for New York politics. New York City Mayor Eric Adams has dropped his re-election bid. Adams citing low polls and a finance dispute, fueling speculation he's clearing the path for Andrew Cuomo to challenge frontrunner Zohran Mamdani. Elsewhere, China's Xi Jinping is reportedly pushing for a major shift in US policy on Taiwan. According to the Wall Street Journal, Beijing is pressuring the White House to formally declare it opposes Taiwan independence, a move that would be a significant diplomatic win for China.
This is one of the biggest stories that are under the radar that I think that really is going on right now. The idea that if this is a more transactional United States, could there be a geopolitical compromise, which is what Xi Jinping ultimately wants, which is to bring Taiwan back under its fold and the U.S. maybe pulling back from the South China Sea, some of the military reserves, et cetera. That's something that a lot of people are watching and wondering, is that up for grabs in this sort of grand détente between these two leaders?
Compare this with the Huawei headline that we got a little bit earlier this morning, aiming to double the highest-end AI chip output by 26. I think to some extent these stories are connected.
The idea of getting leverage and saying we can detach from you, or we can use your tech and be interdependent and help support you, as long as you allow us to really connect with Taiwan more deeply. And this, I think, is what a lot of people are watching. I wonder how much this is going to split the Republican Party, though, because this isn't necessarily a Republican-Democratic issue. This is something that has been unified, bipartisan kind of feeling about Taiwan's independence for a long time.
That's the latest from the Wall Street Journal. Let's stick with geopolitics. President Trump seeming confident that there will be a breakthrough in Gaza ceasefire negotiations, and he prepares for a meeting with the Israeli President Benjamin Netanyahu at the White House.
It's looking like we have a deal on Gaza, and we'll let you know. I think it's a deal that will get the hostages back. It's going to be a deal that will end the war. It's going to be a deal it's going to be peace.
Joining us now, our very own Bloomberg's Annmarie is back in Washington, D.C. with a special guest. Hey, Annmarie.
Hey, John, good morning. Ahead of that meeting today, lunch and then a press conference between Prime Minister Benjamin Netanyahu and President Donald Trump, we're joined by Norman Rule, former senior U.S. intelligence official. Norman, thank you so much for joining us this morning. Ahead of this meeting, the president is sounding very confident. He thinks there could be some sort of breakthrough when it comes to Gaza. Of course, we have been here so many times before. What makes this time different?
Good morning. Well, the president, his team, and even some Israelis have voiced serious optimism in public on these statements. This deal also has general support of the Arab states and even some senior Israeli opposition leaders. However, Hamas has not yet seen the proposal and will resist disarmament and loss of power. The proposal also includes several points that cross very real red lines that could collapse the Netanyahu government. So the deal should not yet be considered certain, as Israel and Palestinians will attempt to modify provisions that touch issues they oppose, and there will be some hard bargaining today at the White House.
The president's team proposed this plan last week on the sidelines of the UN General Assembly to a number of Arab leaders. Do you get a sense that the Arab world is on board with this 20-point plan?
In general, yes. This deal has been coordinated with the Arabs, and it addresses many of the points the Arabs have been seeking for many months. It provides for withdrawal of the Israeli forces. It provides for an end to the violence. It provides for humanitarian support for the Palestinian people. And although it doesn't give a direct path to Palestinian statehood, it provides a center of gravity for the Palestinians to begin some form of an authority that would allow them to rule themselves. And it also provides for the eradication of Hamas, which Arab states all support.
How has Israel's strike on Doha changed the dynamics going into this bilateral meeting for Benjamin Netanyahu and the President of the United States?
Well, the Israeli strike was obviously staunchly opposed by the Arab states. It infuriated the Arab states. It made Israel appear as a source of problems more than a source of solutions in the region, and it put those members of the Abraham Accords in a very difficult position. I think that just put another log in the fire of the ongoing political pressure that the Arab states had already exerted on Europe to produce a greater sense of political support for recognition of the Palestinian state itself at the UN, where there were more than a dozen states that signed on to that. So that initiative, combined with the ongoing violence in Gaza, combined with the many months of quiet diplomacy by Steve Witkoff, Jared Kushner, and Tony Blair, all came together in sort of three trains coming into the station to produce this week's diplomacy at the White House.
Norm, elsewhere in the region, I'd love to get your take on a country you know a tremendous amount about, and this is Iran. And just yesterday, we saw sanctions on Iran given the snapback at the UN General Assembly. What kind of penalties is Tehran going to be seeing with this snapback action?
The most significant aspect of these penalties is that they are UN sanctions, which means in the past, many countries, Russia and China, for example, could ignore U.S. sanctions, saying that they were extraterritorial and therefore sanctions they could ignore. But these are now UN designations, so that in essence, Russia and China will be ignoring UN sanctions. Now, they will ignore those sanctions on oil sales, but this makes it difficult for other countries to participate in Russian, Chinese, Venezuelan sanctions busting. And it makes it much easier for the United States and our partners to clamp down on Iranian sanctions evasions. Already we've seen the Iranian rial increase in its, or rather collapse in its value. And we're going to see some serious economic pressures build in Iran itself in coming months. This will be a very serious economic challenge for an already pressured Iranian regime.
Will these sanctions push Iran to the negotiating table with the United States?
Not in the near term. Iran will need to demonstrate defiance. It will need to demonstrate some sense of its ability to move through these sanctions. But this is a serious challenge for a government that has already proven to be politically bankrupt, facing multiple economic issues for which it has no policy solutions. It's trying to survive the transition to post-revolutionary leadership, and it's got no serious options sitting in front of it. And now it faces the loss of some of its few economic tools. So for Iran itself, it's going to be in a very difficult position. So coming weeks, months, we'll see how these sanctions play out. You're going to see rising costs. You're going to see shipping costs increase. You're going to see Iran having difficulty with some of its exports, its imports. Its very limited foreign investment will diminish even further. And again, its rial will continue to decline in value.
Norm, thank you so much for your time this morning. Norman Roll of CSIS and, of course, a former U.S. intelligence official. John, there's a ton of moving parts right now in the Middle East. We just ended there on Iran and potentially what the secondhand nature is going to be from the snapback of those sanctions on European countries on Iran. But heading into this meeting this afternoon, this is going to be a crucial one for the region between Benjamin Netanyahu and the President of the United States on the heels of the U.S. talking to the entire Arab world at the UN last week about this 21-point plan to try to bring an end to the fighting and get some sort of ceasefire agreement and path forward for Gaza.
Annmarie, Appreciate the update. Anne-Marie down in Washington, D.C. More from AMH in about 30 minutes' time. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. UK Prime Minister Keir Starmer has framed his political survival as his country's best hope of defeating populism. Starmer is trying to regain the faith of Britain's electorate amid complaints his government is not taking radical enough action on concerns such as cost of living and migration. In an interview with the BBC, Starmer drew political battle lines with Nigel Farage's Reform UK. Meanwhile, Moldova's ruling pro-European party is on track to win re-election, keeping the country on the path to EU membership. President Maya Sandu's Action and Solidarity Party received a majority of the votes. Once certified, the results will be a major blow to Russia, which has allegedly spent millions to install pro-Moscow forces in the country. And Huawei is preparing to ramp up production of its most advanced AI chips over the next year. The Chinese company plans to make about 600,000 of its marquee 910C Ascend chips next year. That's about double this year's level. Huawei is also working on a chip powerful enough to train AI algorithms, not just operate them, in order to compete with NVIDIA. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, rate cuts on track.
Households do not like the inflation, so I think it's incumbent on the Federal Reserve to make sure inflation stays low. This leaves everything on track to have further rate cuts during the next two meetings.
Jim Bianco of Bianco Research joins us next. Live from New York City this morning, welcome to the program. Under surveillance this morning, rate cuts on track.
Households do not like the inflation, so I think it's incumbent on the Federal Reserve to make sure inflation stays low and stable. This leaves everything on track to have further rate cuts during the next two meetings of the FOMC. I do think the economy will be in pretty good shape for the rest of this year and into 2026.
So here's the latest this morning. Traders looking ahead to payrolls data due out on Friday after stronger than expected economic data. Jim Bianco of Bianco Research writing the Fed should not continue to cut rates. The economy is doing much better than the consensus. Jim joins us now for more. Jim, welcome to the program, sir. I want your perspective first on the recent Fed debate, the division that we're seeing from the Fed speak of the last week or so. Where do you land on things, Jim?
I think some of that is political. I think some of the Federal Reserve officials are running to try and replace Jay Powell. And I might respectfully say that the quote you had from Jim Bullard is in that camp, too, because it was very inconsistent what he said. And I think some of it is genuine, that there is some that are looking at the economy kind of like I do. And that is that it's doing okay, if not better. The Atlanta Fed GDP number is now nearly 4%. It's higher than every single estimate on Wall Street right now. And the inflation data is staying sticky, and the goods part of data, which would be tariffs, is really starting to show signs that it's moving higher. So for those that say, where's the tariff inflation? It's right there. It's coming. It's underway in the CPI goods category.
Jim, how credible do you think this pursuit of 2% is? It's something that dominated our conversation on decision day. Is this credible?
It's got a problem. And the reason it's got a problem is if you look at the inflation expectations data, I'm talking about like the inflation swaps or the CPI break-even rates, or the TIPS, break-even rates, they're all above 2.5% out till 2030. Well, I know, one of the best questions I heard during the press conference was from Mike McKee, where he pointed out that the Fed said, we'll be at our target in 2 years. And he pointed out the last 11 years, you've said you'll be at your target in 2 years, and you've yet to be at your target in 2 years for 11 straight years, and now you're going to try for a 12th year. And the market is saying you're not going to be at your target for 5 more years, because out to 2030, it's still got, elevated inflation. Not runaway, but definitely not getting anywhere near 2%. And the Fed needs to address that. And they're really not at this point.
At the same time, Jim, can't you say that tacitly, if they're accepting 2.4%, which is currently what break-even rates are pointing out for the next 10 years, is the likely inflation rate? If that is the inflation rate, isn't this market and isn't this Fed saying that's fine, as long as we don't torpedo the labor market, as long as we keep the economy chugging? Where's the problem?
The problem comes in where's the neutral rate. If you're going to accept 2.5% or so as the inflation rate with R-star, that's 3.5%. If you're going to, that would be a 1% premium above that. If you're going to accept 2.5% as inflation, maybe R-star should be a little bit bigger. In other words, you're no longer moderately, you're easy in the market. You're probably at neutral. And if you cut one or two more times this year, you're going to be too easy in the market and you're going to risk fostering more inflation. So it really comes down to, do you want to cut rates two more times? If you do, then you shouldn't be tacitly accepting 2.5% as the inflation rate, long-term inflation rate, because you should be done cutting rates then at this point.
Do you get comfort, Jim, from the fact that after the Fed cut rates, you aren't seeing a steepening of the yield curve? You aren't seeing a runaway at the long end of the yield curve like what we saw last year, that people are seeing there as justification economically for the Fed to be more aggressive?
Yeah, at least at this point, but I fear that we're in a holding pattern waiting for more data. And I also fear we're not going to get that data because we're going to have a government shutdown on Wednesday at midnight. And I'm talking about like the payroll report on Friday and next week, the CPI report. Remember that the last government shutdown under Trump in 2018, 2019 lasted 35 days. And the Fed is effectively going to go into the October 29th meeting with no more government data, which is what they rely on. Jay Powell called it the gold standard, than they have today. And they'll just assume that everything is as they understand it today, and they'll cut rates. And what I'm afraid of is when we get that data, whenever we get that data, it's going to show a meaningful uptick in the economy.
Jim, I want to build on that. We've been talking about this reacceleration now for a while. Market's priced for it into 26. Lisa mentioned Neil Dutta early this morning. This is what he said on the jobs market. If firms expect growth to perk up, it's curious they haven't ramped up hiring an hours already, Jim. What do you say back to that?
You know, I think the issue with the labor market is really the break-even rate right now. We need to start ask the other side of the question, which nobody wants to touch. Okay, we've created 29,000 jobs over the last 3 months. How many should we be creating? And Jay Powell answered that towards the end of his press conference. He said maybe 0 to 50,000. Midpoint of that's 25,000. We've created 29,000. I understand this is a number that we're not used to. To say 29,000 jobs over 3 months is just fine. That's all we need in this economy. But we've got the lowest population growth in almost 100 years because of the closing of the border and increased deportations. And if that's the case, if you have no population growth, you don't need to create that many jobs. So really, this is the crux of the labor market issue. It's not how many manufacturing jobs versus service jobs versus healthcare jobs did we create last month. The fundamental question is, how many do we need? And the answer might be not that many, given low population growth.
Jim, thoughtful stuff. As always, Jim Bianco of Bianco Research. We've heard this a few times. You've had a step down in payrolls growth. You haven't had a step up in labour market slack. And the second one, the latter, is really important when it comes to interest rates. What's curious about Chairman Powell is he was focused on that, and then he wasn't.
Yeah, I knew you were going with this. The idea that suddenly it was the unemployment rate that was the most important because of this concern. And now it's the headline number as there is this concern about more weakness. The kink in the ointment, or the fly in the ointment here, to me, is early market entrants, college graduates, their inability to get a job, the sense that people have where they're not necessarily quitting as frequently and they're not necessarily getting as big raises when they get to another job. Those are the signs that there is something going on that maybe is more than just something that's healthy.
Which obviously has spooked this Federal Reserve.
Correct.
But it's not just a supply story, it's both.
Right.
And they're concerned by one more than they are the other. Up next on the programme, Max Kettner of HSBC, Henrietta Trays of Veda Partners, and we'll catch up with the PIMCO CEO, Manny Roman. That conversation in the next hour.
this is a completely unique environment.
We're entering Act 2 of tariffs.
There's a lot of elements here that can serve as tailwinds to the consumer, but once all that evaporates, we have to wonder where we'll be.
The consumer feels like they are running out of steam.
We think actually you're going to be more able to see where the economy stands in 6 months or so.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Snapping a 3-day losing streak on Friday with some positive follow-through. Up again this morning by 0.6% on the S&P, likewise on the NASDAQ. A rally in the bond market, 2-year, 10-year, 30-year bond yields down across the board. We're lower by 3 basis points on 10s. We're down 2 on 2s. Looking ahead to a week full of economic data, and hopefully we climax on Friday with the payrolls report.
In the meantime, people are going to be putting increasing pressure, increasing emphasis on the ADP report, on the ISM manufacturing, on the JOLTS, the job openings data, all of the other peripheral information that we can get, because ultimately it is such a wild card about whether we will get that data on Friday. Just to give you this perspective, there is now into prediction markets a 3 in 4 chance predicted that the market will shut down and that we probably will not get that labor market report on Friday. So, maybe I'll take it off.
I hope we get the ISMs. Of course we will. And that will show, and this is what I hope for, it's going to show the reacceleration the market's priced for. The jobs market's its own beast right now. We've talked about that. Supply side story versus demand side story, don't know. Okay, continue having that debate. If you believe in this reacceleration story, you've got to hope to see that in the ISMs this week. I think that's really important for both manufacturing and for services too.
And if you take that logic, and I think it is the right way to look at it, then what happens if it's a disappointment? If you do believe that there's going to be more volatility in the markets around some of these peripheral data points, is bad news bad news? If you get some sort of a sign of weakening or a lack of reacceleration in manufacturing, do you get some of the rose off the bloom of all of the people who are betting on a reacceleration? And the likes of Goldman Sachs or Brian Belsky at BMO or other analysts have come out and upgraded their forecast for stocks. Is that part of the story that they need to see come through?
In the long run, good news is just good news. Eric Robertson of Stanchart has said this over the weekend. We may have already seen the trough in the US economic data. That's what the market's priced for. That's what we need to see now. And I hope we see that in the ISM when we get it later this week.
Although, here's the rub, and this is a bit of an issue. This is all predicated on the Fed continuing to ease policy rates. If the Fed gets justification not to ease policy rates because of the reacceleration that's in the data now, does that stymie some of the bullish calls that really see a lift from some of the Fed accommodation?
I mean, possibly, of course, yes. If you look at small caps and they've rallied almost exclusively on the rate story, there'll be pockets of this market that won't like that. What would concern me is what's stopping the Federal Reserve. Is the Federal Reserve constrained by the inflation story or just happy with the growth story? If they're happy with the growth story, that's a good story for risk. It always is over the long term. If they're constrained by the inflation story, we've entered a new regime. That's problematic. And a risk of seeing a repeat of what happened last time when they had to really take a step in and do something about inflation and sacrifice things in the labour market. I hope we don't get there. There's a lot of hope coming out of my mouth this morning. I hope that's not what we see.
Well, I think everyone pretty much agrees with you who's long this market because, as our next guest talks about, the one potential scenario that could stymie the rally and the incredible enthusiasm that we hear around every corner in Wall Street is a suddenly hawkish Federal Reserve exactly because of some sort of inflationary threat.
He's coming up next. Max Kettner of HSBC is going to join us as Wall Street looks to recover from last week's losses. Plus, Henrietta Trey's of Vader Partners as the government shutdown standoff deepens, and the PIMCO CEO, Manny Roman, on financing the AI infrastructure boom. We begin this hour with stocks inching higher as investors continue to navigate the AI boom. Max Kettner of HSBC saying things are looking up, writing the broad-based asset price inflation is continuing full throttle, and we think there's more to come. Max joins us now for more. Max, good morning.
Good morning.
See you. We were talking about your note you published earlier this morning, so I think we should probably start there. So here's the line. We still see clear signs of US and global growth reaccelerating in contrast to downbeat consensus expectations. Lisa, straight away, bang. What's downbeat about consensus expectations into next year?
Look, I think when we look at both earnings expectations and top-down GDP expectations, they are still pretty downbeat. Certainly not where GDP now is, where all the high-frequency data are, both top-down and bottom-up. If you look at bottom-up, actually, when we strip out tech, earnings expectations Q3 versus Q2 are pretty much flat. So we're going into Q3 earnings season in a couple of weeks where, for most sectors, actually consensus is saying earnings are either going to be flat or down quarter over quarter sequentially. In a quarter where probably growth has been really, really robust from a top-down perspective. That doesn't make sense. If you look at Q4, even GDP, what we're seeing is it's barely 1% quarter-over-quarter annualized growth expected. Again, what we are not only seeing at the headline number, that 1%, which is a 0.25% annualized, but when we look at the contributions to that, consensus is still saying there won't be any comeback of investment. And that doesn't make sense to me. You can't say we've got a little bit less political uncertainty. We kind of know how to deal with this environment now. We've got the big, beautiful bill coming through. We've got wealth gains coming through. We've obviously got, these AI capex story coming through. But at the same time, consensus is saying, nope, all this tariff story, it's going to continue weighing on investment in particular. And that's really big upside surprise potential.
I think the reason why both John and I were a little bit confused by this idea of consensus is because in the past couple of days, Brian Belsky saying 7,000 for next year, not necessarily high enough. Christian Muller-Glissman over at Goldman Sachs upgrading their forecasts, and Goldman Sachs keeps upgrading to the markets repeatedly. John Stoltzfus, the biggest bull on Wall Street, you see others just coming out of the woodwork talking about 7,700 on the S&P for next year. How can you say that's a bearish outlook or not bullish enough?
Yeah, look, actually, what we are seeing now, that sort of streak of upgrades, that's the most bullish thing that you can imagine. Because we run a series called Consensus GDP Forecast Diffusion Index, where we actually look at the data that you guys produce, so all those consensus expectations around GDP. Once that shoots higher, so once you really see upgrades across the board for the major global economies, so for the likes of the US, Canada, China, Eurozone, and so on, that is really, really bullish. Right, particularly for cyclicality, particularly not only for adding for equities and not just, okay, it's a monetary driven story, it's probably tech outperforming, but really for cyclicals to outperform. Now, on the other hand, let's not just focus on the expectations and on people upgrading their, the year ahead forecasts, but also about the market action. When we look at the market action year to date and you look within the S&P, cyclicals are up pretty much the same as defensives. So it's not like cyclicals are up 20% and defensives are like 5%. And you're like, wow, this is all baked into price action already. No, both are up, give or take 9%. So it's not like actually price action is telling us, wow, there's so much hope into cyclicals baked in.
Not to be a negative Nelly, but you could argue, hold on a second, not always. I'm just contrarian Courtney. Look, honestly, we're looking forward and we're talking about Please, bear with me. Honestly, you could say if things were looking so good, why is the Fed cutting rates?
That makes it even more bullish. If we're honest.
Right, sure, but why should they cut rates?
They shouldn't. I mean, don't ask a German why they should cut rates, right? The German will always say they shouldn't be cutting rates. No, I mean, look, I guess the point is to bring it back to slightly more, serious topics. If we look at what the Fed can do, can they cut another 1 or 2 times? Sure, fine. Should they necessarily, with uber loose and easy financial conditions? Probably not. With 3-ish inflation, should they really be cutting a lot? Probably not. But at the same time, what we undeniably have is we have weakness in the economy. It's very different. The economy is on 2 very different paths. Let's be honest. If we weren't market people, if we were people working in the labor department, we'd be talking about the economy very, very differently. There is absolute strains on the weaker part of the economy. We're talking about the Russell 2000, John. You were talking about the Russell 2000. Let's go one step down. Let's go to the smallest caps that aren't actually listed. There is very clear strain. They can't get funding. You look at credit card delinquencies, auto loan delinquencies. Look at real wage growth, the highest wage growth percentiles versus the lowest ones. The lowest ones are already going to around 0% real wage growth. Tariffs, of course, are eating into the lower-end consumer goods, into things like food and beverages that already have outstripped cumulatively inflation since COVID. Now you add on tariffs. It's a clear strain on the weaker part of the economy, and they need the rate cuts. What that, of course, for us means it's even better for asset price inflation. And because you've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
That story you described doesn't make you bearish. In fact, it makes you incrementally more bullish because they're going to have to respond to it. What would make you bearish is what Lisa is trying to ask here.
Yeah, I think, look, it is very clear. Anything around, let's say, Supreme Court or government shutdown, that's like, yeah, can we get like 1 or 2 or 3% down? Sure, right? A handful of percent down. But at the end of the day, this is just buy the dip opportunities. The reality is, if we get a return to 2022, where the Fed says, "Oh, shoot, we are very wrong. This is like 2022. This is transitory." If we say, "Oh, you know what? This is not just 3%. This is entrenched 3%, and 3% seems to be the low now, and now we're reaccelerating even inflation." We're not even done cutting. We're not even stopping. We're actually, the next move is a hike. Once we get that puts a stop to it. How far are we away from that? Minimum 2 quarters. Last week, I still had conversations about, they're going to do 50 in October. We're minimum 2 quarters away from that, because let's remember, we have had this reacceleration in the data that, not a lot of people were talking about a month and a half, 2 months ago. Now it's sort of creeping into people really and saying, hey, look, yeah, the US seems to be doing better from an aggregate growth perspective, but what we really need for a proper hawkish shift is actually a reacceleration in the labor market. And given that supply story, given that really low break-even number, it's almost impossible to get that in the next couple of months. Right? So that makes it sounds intuitively completely wrong, but it's the best of both worlds. You get a sort of weak-ish labor market, but you've got reaccelerating activity data, which means good earnings, but sort of sluggish consensus expectations, low bar to beat, but at the same time rate cuts into a reacceleration. Which, Lisa, to your point, is that a policy mistake? I think so. But of course, that's probably a story we're going to play in 2026, not the next 6 months.
Max, smart, and good to see you. Thank you, sir. That's the bull case this morning from Max Kettner of HSBC and Contrarian Courtney. Coming along for the conversation.
I shouldn't have said that.
Let go. Where did that come from?
I don't know. It was just, one of those things. Happy Monday. Look, what Max is talking about is really important. It's this idea of not what the Fed should do. It's what they will do. I just wonder, are rate cuts the most efficient way of targeting the K-shaped economy? Is that the best way to help the lower income sphere of earners in the United States of America and frankly around the world? Or is that just inflating the asset bubble and creating an even bigger divide? And ultimately, is that going to be the policy mistake that we come back to?
I think Max is saying it's the latter and he's going along for the ride.
I think a lot of people are.
Basically. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump said the government is likely to shut down unless Democrats back down from their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The top 4 congressional leaders will meet with the president today at the White House, a day before funding is set to run out. Meanwhile, at least 4 people were killed and several others injured at a Michigan Latter-day Saints church on Sunday. A gunman rammed a truck into the building packed with worshipers, opened fire, and deliberately set the church ablaze. The suspect was killed after officers engaged in gunfire with him at the church parking lot. And New York City Mayor Eric Adams has ended his re-election bid. The announcement follows reports that Adams was entertaining potential job offers from the Trump administration and the private sector. That's in exchange for bowing out of the race to allow former New York Governor Andrew Cuomo to challenge Democratic nominee Zohran Mamdani. Carlos Sliwa is also still in the race. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, finding common ground.
We want to find bipartisan common ground to find a spending agreement that avoids a government shutdown.
You don't hold the people hostage for their services to allow yourself political cover, and that's what Chuck Schumer and Hakeem Jeffries are doing right now.
Up next on the program, Henrietta Trays of Veda Partners with Annmarie down in Washington, D.C., and a sprinkle of guess who? Contrarian Courtney for the next 2 hours.
Come on.
You think I'm forgetting that anytime soon? Contrarian Courtney, what on earth was that? What was that?
Well, it was just, I'm not negative Nelly. Then Contrarian,
Yeah,
what name would you put?
All right, yeah.
Courtney.
I wasn't coming up with names for you this morning.
Let's move on.
A big week coming up, packed with economic data. We're hoping to get the payrolls report on Friday. If you don't get that, we'll get the private market indicators, the likes of ADP on Wednesday. Look out for the ISMs, the PMIs. That's where the focus is going to be for market participants.
Yeah, ultimately, you use what you get. If you ultimately have a Fed that is data dependent, well, what do you do if you don't get data? You look at other data, the tertiary data that's going to take on increased import make ADP great again. That's going to be this week.
Then it's already been happening, hasn't it, over the past few months?
It has. It's been a disproportionate response. I just wonder how volatile markets will be in response to some of these data points that often are viewed as not consistent necessarily with the labor market report.
Particularly given the divide we've had over the Federal Reserve more recently. The scores so far this morning, pretty good. Up again following Friday's gains, up this Monday by 0.5% on the S&P, on the Nasdaq by 0.6. Under surveillance this morning, finding common ground.
We want to find bipartisan common ground to find a spending agreement that avoids a government shutdown and actually meets the needs of the American people in terms of their health, their safety, and their economic well-being.
It's fine to have partisan debates and squabbles, but you don't hold the people hostage for their services to allow yourself political cover, and that's what Chuck Schumer and Hakeem Jeffries are doing right now.
So here's the latest this morning. Congressional leadership from both sides of the aisle meeting with President Donald Trump today in an effort to avoid a government shutdown. Annmarie joins us now from Washington with a special guest. Hey, Annmarie.
Hey, John, good morning. Well, ahead of that meeting with the president, it doesn't seem like either side, Republicans or Democrats in Congress, are prepared to blink. And we're now joined by Henrietta Treyz of Veda Partners, who has a 70% chance that the government will shut down tomorrow at midnight. Henrietta, my first question's got to be, why not is it not 100%, given the fact that House Republicans aren't even coming back to Washington?
Yeah, I speak with staff on the Hill all day long, and they have been at 90% for quite some time now. I guess my reticence is just that we are still many hours away from an actual shutdown. And when it gets to this high media tension, high intensity dynamic, you don't get a resolution until the 11th hour. There are a couple of ways to get off ramps here. My odds of 70% are very high for me, about on par with the poly market odds that we've gotten now since this meeting of the Big Five, I guess, was announced for later on today. So we'll see how it goes. There's just a long way off is basically my point and why I'm at 70% odds.
What off-ramps are you looking at that could be a potential in the final hours?
I want a short-term stopgap. I want like 3, 5, 7 days, nothing major. The bottom line is that there is a lot of very serious red meat that you can throw at both sides. The farmers need a bailout, for example, as China stops buying soy from the United States. The Democrats want ACA subsidies. That's a huge boon to 22 million individuals across the country. We want aid to Ukraine. There's a number of pieces that are problematic from the market perspective, suspending BLS data. A lot of chips to play here, and there are cards for both sides to deal.
On the BLS data, even if we get a shutdown, do you think we will get Friday's jobs report?
I'm optimistic that we'll get Friday's report because basically the president is going to have to decide that he just doesn't want to turn the internet on that day in order to avoid it. And I think the market's going to respond really negatively to that. In meetings across New York with investors last week, this came up in every single conversation. We've already had to deal with the firing of the BLS commissioner earlier this summer. And, we're dealing with fiscal dominance on the Fed side and even at the Supreme Court. The market's going to react here. And given the timing where we can collect data all the way through the 30th of September until midnight, and then the jobs report is just 48 hours away, that should be pretty much finalized. All the commissioner really has to do is press send. We should get skeptical about reports coming 3, 4, 5 weeks later, maybe even 5 days later if you want to get to it. But at this point, refusing to release the BLS data is going to be a problem for the markets. And I think that cooler heads will hopefully prevail on that one.
Okay, so you think we get Friday's report, but looking forward, it's a little bit more murky depending on how long the shutdown could be. In Trump's first term, we saw a 35-day shutdown. Do you think we get to see something as elongated as that?
That's not current conventional wisdom amongst staff. I point to a dynamic on the Hill, which is that of the 750,000 employees that are going to be furloughed in this shutdown event, a lot of them get paid on every other Friday. And so that, in this case, is October 10th. And that points to a relatively short 10, 11, 12, 13-day shutdown where staff can then get back paid as late as Monday, something like that. So that every other Friday dynamic is just a little inside baseball tidbit to keep in mind if you're an investor watching how long this could shut down. Their staff starts to hurt and feel it by the 10th.
Who do you think is going to get the political blowback when it comes to a government shutdown, Republicans or Democrats?
Well, polling suggests that Republicans are going to fault Democrats and Democrats are going to fault Republicans. The reality of the situation is that it's hard for Republicans to message that it's somehow not their fault, given that they control the White House, the House, and the Senate. Americans are used to Republicans being the driving force behind a shutdown. So in 2018 and 19, it was President Trump advocating for a border wall. Before that, it was Ted Cruz, if I'm not mistaken, on the Senate side. So this is a situation where Democrats usually are not in this position. They're always the ones that fold like a lawn chair, which I know we've talked about in years past. This is a dynamic that's a little bit fresh, and they're fighting over ACA subsidies, which is an old saw for them. They feel like they've got the American public understanding that they're the more trusted party on healthcare. When I talk to staff, there's some reticence about moving it to a tariff discussion, which polls very well for them and very poorly for the president, but they're really sticking to healthcare. I think it's bad look for everybody personally.
Speaking of tariffs, you mentioned China. China has not booked a single soybean cargo. How quickly could we see this Congress actually give a bailout to farmers?
I mean, they could put it in the CR right now. This is exactly the narrative. If you're from Nebraska, Illinois, any of the farming states, if you're Chuck Grassley, you've seen that he's furious over the weekend because Secretary Bessent is planning a $20 billion bailout for Argentina, who simultaneously is getting all the soy purchases from China and stealing our market share. That's permanent spending loss. You know, if you look at soy data, it's really fascinating. In the president's first term, they were selling over 14 billion bushels of $1 billion worth of bushels of soy to China every year. Now we're already down to 12. And given the extent of this trade war, we're now selling 0 to China. So the trajectory under Trump for farmers has been straight down, and now it's in bankruptcy territory. So there's a lot of impetus for Republican lawmakers on the House and Senate side to insert a bailout for farmers in this CR, as they are going to go bankrupt with their soy, just rotting on the vine right now.
So you're saying they could do it as soon as this CR. Will they? Will the Democrats also sign up for that?
I think there's enough opportunity for give and take on both sides. In one case, you avoid a government shutdown, which is, I think, going to disproportionately hurt Democrats this time around. Russ Vaught at OMB is making it really clear that he wants to have this be as much blue state targeted as possible. Plus, you want the health care subsidies. Plus, you want additional potential assistance to Ukraine. Plus, you want a farmer's bailout. There's a lot to go around here, and I like that. That's usually how you can get a resolution. This could become, maybe not by Wednesday, but shortly thereafter, if they get a little bit of a stopgap, a much bigger deal.
Henrietta, thank you so much for your time this morning. That's, of course, Henrietta Trace of Veda Partners. Jonathan, she thinks there's potential for an off-ramp before midnight tomorrow. And most importantly for financial markets, she thinks we get the jobs report on Friday.
Anne-Marie, fingers crossed. Hopefully we will this coming Friday. MH, thank you. Anne-Marie bringing up the right story there. Soybeans. This relationship between China and America over that one issue is problematic. They've been leaning on Brazil for a long time to build up a more reliable source of soybeans. And now we've got a domestic problem in the US that the government arguably needs to address.
And part of the way that they're going to address this potentially is to take money that they're getting from the tariffs and giving subsidies to soy farmers. Look, this is a real question of which constituents are going to get hit hardest from which parts of this dispersion between the US and China, as well as some of the tariff revenues. How does this administration deal with it? How much pushback do you get from certain Republican Congress members in response to select policies? This is where I'm watching to understand what carve-outs are really asked for or what subsidies are requested.
Unfortunately, this has been a strategy of the Chinese for quite a while now, to put some heat on the Republican states, to try and put some heat on the administration led by President Trump. We'll see if we get changes on that issue. Coming up on the programme, we'll catch up with the PIMCO CEO, Manny Roman, on financing the AI infrastructure boom and a whole lot more. Plus, Danny, has your morning movers Carnival shares higher ahead of their latest earnings report? That stock is up by 1.6%. From New York City this morning, good morning to you all. Equity futures positive by 0.5%. In the bond market, a rally. Yields down on a 10-year maturity by 3 basis points. Your yield this morning, 4.15. Live from New York City this morning. Good morning. Equity futures on the S&P 500 positive by 0.4%. A lift in this market following Friday's gains, snapping a three-day losing streak. On the Nasdaq 100 this morning, higher by 0.5. If you switch at the board and get to the bond market, 2-year, 10-year and 30-year bond yields down across the board this morning, down by 1 on 2s, down by 2 on 10s. Your 10-year 4.15, going into a week full of economic data where we hope, and I keep saying that word, we hope we get the payrolls report this coming Friday.
If the government shuts down, we probably will not get that labor market report. And then all of a sudden we will have a jolt report that's going to jolt a market disproportionately. The volatility on the heels of all the peripheral measures, I think, is what to watch this week.
If you are intrigued by the payrolls report, if we get it, the median estimate is 50K. The low is negative 20 and the high is positive 105. And a lot of I don't know somewhere in between. 2 hours from the opening bell, let's get you some single names, some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Occidental rising this morning, up 1.4%. An FT story that they're looking at selling their OxyChem unit. It's their petrochemical unit. It would go for about $10 billion. They didn't name a buyer, but they have been offloading a lot of their assets in a bid to reduce some of their debt. So again, those shares rising this morning. Also rising ahead of their earnings is Carnival Cruises. Those shares up 1.2%. They'll be reporting their earnings at 9:15 or thereabouts a.m. this morning. A lot of enthusiasm about it. Barclays points out that they're probably going to come out with a strong showing, especially given that some of their peers, Royal Caribbean, alongside some of the other ones like Norwegian Cruises, have been doing really well. By the way, Matt Miller and I will be speaking to the Norwegian Cruises CEO in the 10 a.m. hour, so one to pay attention to later this morning. Finally, wrapping things up with wheat stocks this morning. Having an excellent morning. Tilray up 18%, for example. Canopy up 14%. Aurora Cannabis up 10.7%. After President Trump put a video on Truth Social, kind of looks like an infomercial sort of thing that touted the benefits for CBD for seniors. So off the back of that, you get this rally. John?
Danny, thank you. More from Danny in the next hour. Appreciate it. Danny, thank you. On a radar this morning, President Donald Trump saying negotiations for a Gaza peace deal are in their final stages. The president meeting today with Israeli Prime Minister Benjamin Netanyahu at the White House. President Trump meeting with a bipartisan group of congressional leaders as well today as a government shutdown looms. Trump says the shutdown is likely unless Democrats drop their demands to extend health insurance subsidies. And finally, Vice President J.D. Vance saying he's confident that U.S. version of TikTok has been successfully separated from its Chinese parent company. President Trump signing an executive order last week approving the proposed deal.
There's still a lot of questions about exactly what the parameters of this are. Oracle to own something like 45% of it, and then this idea that the ByteDance operation over in China will get 50% of the profits from the U.S. entity, but the algorithm will be run by the United States. A lot of questions about Xi signing off on this, what exactly this is contingent on, and this really has raised a lot of questions about the larger deal. People saying this was incremental, more discussion about what else has been agreed upon between Xi Jinping and President Donald Trump.
It's the price I want to talk about. Brent Thill was joining us a little bit later.
You mean that it's nothing?
It's like nothing.
Yes.
Compared to what this would get if they just span it off.
Yeah, so what do you think of that? Do you think that this was just sort of a devaluation to give an easy, cheap entry point to the U.S. investors coming in? Do you think that this is trying to downplay the value of this asset in the United States? I mean, what's the ramification given the fact that it should be twice as expensive at least?
I'll let others speculate. I'll just say that those that have got their fingers in this pie have done pretty well and will do pretty well in the years to come based on the appetite for that app.
We all feel for Larry Ellison about how he's done so far and are really happy to hear that he's added to his wealth. Congratulations.
I don't even think the smallest violin. I can't even play that. But Larry's life is just so good.
It's ridiculous. I mean, honestly, between the sailing and his private islands and his endless wealth, yes.
He's having a good time. Let's put it that way. Let's stick with tech. McKinsey estimating that data centers will require $6.7 trillion to meet demand for computing power globally by 2030. Private credit firms are laying the groundwork to help provide the capital. Meta is said to have selected PIMCO to help lead a $29 billion financing for its data center expansion. I'm happy to say the PIMCO CEO, Manny Roman, joins us now for more. Manny, good morning.
Good morning, Jonathan. Nice to see you.
It's good to see you, sir. How does a man like you deal with a 3 a.m. alarm clock on the West Coast? How does that work? You've got our life.
I make the best espresso known to mankind. You know, and you'll be happy.
Triple espresso?
Triple espresso. And it feels good every day and happy to be at work.
Well, I'm happy to have you with us this morning. Let's get into some of these deals. I know there's certain deals you can talk about, can't talk about. I want to talk in broad terms about the appetite here. for the capital that we need to provide to this particular force, this growing force, AI data centers, where it's going to come from, and where you and the team are going to fit in?
So I think it's a huge super secular opportunity. There is an enormous need for funding and equity in data center. I don't know whether the $6.7 trillion from McKinsey is remotely right, but it's very, very big, and there'll be plenty of financing deals to be done, and there'll be plenty of construction to be done, and it's true in the US, but it's true in other parts of the world. And the need also to have the infrastructure and the energy will come after that. So, we all talk about data center, but there's going to be a real rush for energy in terms of providing the right setup for all this data center. And, that's one of the reasons to be very bullish on natural gas.
We've reflected on one particular statement from one particular tech CEO over the last 12 months that I think was really quite important. It was last summer. It was the Alphabet CEO, when essentially he said that the greatest risk here was underinvesting and not overinvesting. And I wonder how you think about that from the perspective as an asset manager, when you've got a group of companies that are willing to run the risk of overinvesting. How do you think about the risk around it?
In terms of, I think what we will do is we will look at every single deal and we will say this makes sense for us and this may make less sense. And I think one of the strengths we have is to be pretty focused on relative value and sort of think that there may be a fantastic deal to be done, which will be very, very good for our investors. And then we look at the next one in the full light of day and decide whether it fits our portfolio and whether this is something we want to do.
I think it's important to build on this, that Mark Rowan said recently, we are what we originate. When it comes to private markets, you are what you originate. It's quite labor intensive. It takes a lot of work. When you think about scaling this and building this as an opportunity, how difficult is it in practice?
I think we have built it differently from Mark. We have built it based on our experience in fixed income, our experience in relative value, in a history of 54 years, in looking at all sorts of credit. We have 55 credit analysts who looks at every single segment of the market. And I think we look at it from a value standpoint. Does it make sense? Is it something we want to do? We shouldn't be originating for the sake of originating. And there's a lot of money. There's a lot of money coming to this market. Some sectors will be very attractive and some will be less so. And I think you want to be very much on top of this and say, I want to do this and I want to do less of this.
There's a concern, especially as CEOs say, it's more important to be throwing enough money at this rather than being underinvested. And then you have people like David Einhorn of Greenlight coming out and saying the numbers that are being thrown around are so extreme that it's really, really hard to understand them. How difficult is it to invest in a market where people are throwing spaghetti at the wall to try to understand what's going to stick? And there is a feeling of excess that continues to bubble up around this.
So my friend Richard Thaler, who is an economic Nobel Prize and consult for us, has this say. He says, when you make long-term prediction, the degree of humidity and the standard deviation around the estimate should be very, very big. So when I hear an estimate like $6.7 trillion, I don't know what to make of it. David may be right, but we'll take it one step at a time. I think 6 months horizon is about all we can do in terms of the demand. And then, the environment may change dramatically. There are business cycles. Sometimes things are cheap. Sometimes they're expensive. If there's a recession, all of a sudden spreads will widen. Company may revisit what they're trying to do, and so on and so forth.
So this is the difficulty. How do you have a 6-month horizon when a lot of these investments are 10-year build-outs, when they're 10-year usage, when they are labor-intensive, and infrastructure projects by nature are a lot longer than 6 months?
So in terms of committing capital and in terms of finding the right opportunity with the right length of time, we're totally fine to have a very long-term horizon. What I'm saying is making long-term prediction in terms of how big the market will be, it's very hard. I think you have some visibility over the next 6 months in terms of what the demand is, what the real demand is, and whether that slows down or whether that accelerates. You just don't know. And I think you have to be very humble about these things and just say, look, we'll take it one step at a time and see what the market gives us. And by the way, there may be other opportunities which are more attractive. You look, for example, in our asset-backed finance business, aircraft leasing. Aircraft leasing is incredibly interesting, and then nothing happens for 5 years, and then it becomes very interesting again. And you gotta constantly say to yourself, are there better opportunities for me to deploy money? And what do I want to do? How do I think about the risk? How will I get out? What's the right risk-return profile?
You made a headline recently. Wanted to ask you about it. Private markets haven't been tested. Can you build that out a little bit more? What did you mean when you said that private markets haven't been tested?
Well, my partner, Dan Iverson, and our CIO of Core, Mohit Mittal, have the charts. And we checked the number about 20 times because we kind of didn't believe it. But it shows the return on weak single B, which is a reasonably good proxy for direct lending. And what you see is you make money because the yield is higher, and then there's a recession, and then you lose it all. And so I'm old enough to remember 1991. I saw that. There's a recession which came out of nowhere from, essentially SNL having too much high yield. 1997, the world is absolutely fine until there's an Asian crisis, and then you have LTCM, and then things become very cheap. And so you got to remember these things. And we have been in a period since 2009 of exceptionalism, where you have had very strong equity return and very strong high yield return. If you believe this is going to continue for the next 15 years, then I think you should have the same position. But it may not be the case. And I think we bring that and say the data is at the data.
Do you see parallels between now and those periods?
Well, I think the initial condition where we are right now are such that equity markets are expensive by any measure. They may go higher because momentum is strong, and credit market are tight in some part of the spectrum. And I think that's the reality. And look, we've been in a period where things are expensive for a long time. 2005, 2006 were such period where things remain expensive and became more expensive, and then something breaks, and then all of a sudden you have a lot of work to be done.
We're going to spend some time on that in just a moment. Manny Roman's going to stick with us, the PIMCO CEO, Manny Roman. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Lufthansa is planning to cut 4,000 administrative jobs by 2030 as the carrier seeks to improve profitability. The job reductions will occur through digitalization, automation, and process consolidation, with a majority of the reductions in Germany. Meanwhile, First Brands has filed for Chapter 11 bankruptcy. A group of creditors are set to provide the automotive parts company with $1.1 billion in debtor-in-possession financing to keep operations running. This comes after mounting scrutiny over First Brands' reliance on borrowing against future cash flows. And gold is pushing to a fresh record above $3,800 an ounce. The precious metal is getting a boost from investors concerned about a potential government shutdown and pulling back from the U.S. dollar. Other metals, including silver, palladium, and platinum, are also rallying. Gold is up over 45% this year. That's your Bloomberg Brief. John?
What a rally for 2025. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, excessively restrictive.
The neutral rate is drifting down, and as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
That conversation will continue with the PIMCO CEO, Manny Roman, live from New York City this morning. You're watching Bloomberg TV. Live from New York City this morning. Good morning to all. Equity futures on the S&P 500 firmer here by 0.4%. Likewise on the Nasdaq, higher by 0.5%. Under surveillance this morning, excessively restrictive.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Investors turning their attention to this week's Fed speak and the jobs data after Friday's soft inflation print. The PIMCO CEO, Manny Roman, is still with us, and he's back for more. Manny, let's continue the conversation we were having. Equity markets very close to all-time highs, credit spreads near multi-decade tights on investment grade, high-yield spreads near the tights of the year. And yet we've got a Fed official saying that we're excessively restrictive. You're across a range of funds. You look across markets all the time and the economy with the team. Do you see any signs that we're excessively restrictive?
Well, I think rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. And, we talk here about the US, but look at the UK. The UK, where you're from, is, 10-year rates are 4 3/4. Australia looks really, really attractive. So when we think about the opportunity in a way, yes, we do expect the Fed to cut. How much they're going to cut next year remains to be proven. No one knows what's going to happen to the labor market. But the reality is the opportunity in terms of global fixed income is very, very big. And the opportunity to add alpha is quite high. I'll tell you a funny story. We have a partner in Tokyo called Tomoya Masano. And, for the longest time, there's not much happening in Tokyo. So you sort of call him and you have matcha with him and not much is happening. And then all of a sudden, the Japanese fixed income market becomes super exciting. And then there's a lot to do. And there's a whole generation of people who have disappeared because they don't do it anymore. And so you have a labor market which hasn't supplied fixed income investor because there was nothing to do for the longest time. And so what I think is interesting is the difference of view, the difference of opinion is also a source of incredible alpha. And, if you want to think about why performance has been quite good, it's partially because the alpha that is being given by the market is quite good.
I think it's interesting that John was talking about the Fed and you talk about the international sphere. And I think that that's really telling about what people are looking to for that alpha, for that incremental extra yield. Are those Japanese investors staying in Japan right now and not coming to the U.S. for treasuries, even if the Fed cuts?
No, I think they're very big investors in U.S. assets. And remember, one of the opportunity everyone has is to buy foreign assets and swap them back into dollars or swap them back into yen and so on and so forth. And so you can actually buy synthetic credit, you can buy synthetic dollar exposure for U.S. investors buying, for example, JGB and selling forward the yen into dollar and having a different credit risk with JGB than you have with US dollar. And so there's a lot to do. Now, we do that a lot in short term and longer term in terms of adding alpha, but all the time you can do this sort of transaction and sort of mitigate your exposure or increase your exposure or have different risk profile.
That's a much smarter way of looking at it. I'm looking at this with sort of a blunt instrument, sort of dumb. Do you like international more than the United States?
No, but I mean,
and you come up with this really wonderful, nuanced view.
Japan has an enormous amount of money to put to work and is a nation of savers. And so the thing that I always say is you need to put your money somewhere. And the reality is the US is the only place where you can actually put scale. And when you want to think, for example, of the Australian problem, there was a whole delegation last week from the UN from Australia. They need to move capital away from Australia because they are a nation of savers and the Australian market is not big enough for them. And so they need to pivot to...
For a long time, Japan had to do the same thing. They didn't have the yield. To your point, the story's changed. One thing we're trying to track is whether the Japanese bring the money home, whether we see this great repatriation where it could leave markets vulnerable, where typically they deploy that capital. I'm thinking of certain European markets, the US as well. Are you seeing any of that flow story start to turn?
No, not so far.
Would you expect it to change?
Honestly, not really. These things are very, very slow to move. And the reality is people keep on saving in Japan. And so it may just be that the marginal dollar goes into JGB, but the credit markets are very underdeveloped. And if you want to buy, for example, single A exposure, you're much better off going to the US.
The conversation we had back in April was maybe the decline of US exceptionalism. The money was going to leave, it was going to go elsewhere. I want to understand where you are now 6 months later. What did you see at the time in April? Did we start to see that decay click into US exceptionalism? And are we back to where we were at the start of the year just 6 months later?
So I think we were dollar underweighted. We literally just square off our position. We're still very much like emerging market currency. We do like Australian dollars. There's plenty to do, but there was a short dollar position to be had, and it moved 10%, and I think we decided to square our position.
You're talking a lot about rates and the era of income. We've been talking a lot about that just based on the fact that yield has been higher. We're talking about private investments through infrastructure. You're not mentioning equities. And this is a time when people are talking about...
I'm a fixed income guy.
No, I know, and where you have sympathy with us. But I'm wondering how much a higher rate regime limits future equity returns. We used to talk about that. That was before 3 years consecutive 20+% returns. I mean, at what point will it constrain the equity side of the portfolio, even though some people are wondering what kind of buffer bonds really provide?
Well, the PIMCO view is that equity return in the US is going to be 6% for the next 3 years or something like this. I mean, we look at CAPE valuation, it's trading at 28 times earnings. It looks really, really high to us. We understand the excitement about the hyperscaler. But if you look outside of the hyperscaler, life in industrial America isn't great. I mean, top line is not growing. And one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin and so on and so forth. And we don't know that. And so there's a whole leg of the equation that we haven't really seen.
Stock investors have been trying to outbull each other this morning. And Max Kettner was on earlier of HSBC, and he was saying, look, he thinks that the Fed is making a policy error by cutting more significantly, but they're along for the ride because it's just going to inflate the prices of assets significantly. They want to gain from that. Do you agree with that assessment?
Well, I haven't listened to him, so I would not be
good initial punt. I mean, do you think? Yeah.
I don't know. We have a lot of trust in the Fed in terms of them doing the right thing, and I think that the Fed usually doesn't know much more than we all do. They look at the same data, and so the decision is a very well thought out decision where they will decide what to do with the condition that they are being given. And if, for example, we were to see a very bad inflation print, it would be very difficult for them to cut. Now, they may argue that they have to look through inflation and so on and so forth, but the Fed is a very rational actor in the market, and I don't think anything's going to change. And the same goes for the central bank in the UK and the ECB and so on and so forth. And I think once you're in a job, your behavior changes also in terms of how you think about what the right thing to do is.
Are you alluding to the new Fed chair next year?
No,
when you say
I'm just saying it's like being a Supreme Court justice. It's a very important job, and I think people take their job very seriously.
There could be a big change next year. There's going to be a new Fed chair. Do you expect to see any daylight between a Fed chair appointed by this White House and Chairman Jay Powell and his current leadership?
I was reflecting on this and we were talking about this. I mean, every single Fed chair has been, to some degree, a political appointee. And, there's been a history of very good Fed chair since the Burns and the Nixon presidency. And I see no reason why that would change.
The list of candidates we've seen so far, we've said it repeatedly, very credible names on that list from this White House and the Treasury.
Yeah. And it is important to remember that it's in everyone's incentive to have a very credible Fed chair because the market will not like a non-credible Fed chair.
You're running?
I was going to say
you fancy
the same thing.
No, you're happy on the West Coast, right?
He didn't answer, so that means yes, he's confirmed.
I don't think Manny wants that job.
Manny, it's good to see you. Thank you, sir.
Good to see you. Thank you for having me.
We'll do this in Newport next time, okay?
Absolutely.
When the weather starts to warm up a little bit around spring.
Or when it's very cold in New York City.
Either.
Right.
Winter turn of the year works for me.
Vacation?
January time.
Play golf.
Yeah, we'll try and make that happen. All right. Manny, thank you, sir. Appreciate it. Manny Roman there, the PIMCO CEO. Coming up, Jonathan Colliver of Seaport Global, Brent Thill of Jefferies, Lindsay Piegza of Stifel, and Jim Karen of Morgan Stanley. The third hour of Bloomberg Surveillance is up next.
Lost some of that underlying momentum in the equity markets.
We're heading towards a seasonally weaker October.
It is getting more challenging as the valuations are getting tapped out.
We are relying on such a small cohort of names to drive this kind of upside.
There's as much melt-up risk as there is meltdown.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures positive by 0.5% on the S&P 500. On the Nasdaq up by 0.6. In the bond market, a rally, yields down by 3 basis points on 10s ahead of a massive week for economic data.
Yeah, that's supposed to be capped off by non-farm payrolls that we probably won't get, although maybe there'll be some deals struck in the next 24 hours after that October 1st deadline. Look, this is going to be a week where all the other data is going to take on that much importance. I feel like a broken record, but at the same time, the ISM manufacturing tomorrow, the JOLTS job openings data, the sentiment data, what we get from ADP, all of these other metrics are going to take on that much more importance, because if we don't get the non-farm payrolls on Friday and we don't get CPI in the following week, the Fed has no new information before their next meeting.
We've got a deal to work through as well.
Yeah.
The team at Bloomberg leading the reporting on this, just confirmed by the company itself, video game maker Electronic Arts going private at about $210 a share. This is a $50 billion plus deal. The agreement and the investors behind it, Silver Lake Management, Saudi Arabia's public investment fund, and Jared Kushner's Affinity Partners.
And it comes with a 25% premium to Electronic Arts closing price on Friday. This is one of the largest leverage buyouts ever. I believe it would be one of the year's biggest deals, potentially the largest buyout on record. And it raises a question about where we are in the cycle. When you start to see massive leverage buyouts, it doesn't make you feel like you're at the beginning stages of some sort of rally or market cycle. So does this feed into this idea that we're reaching some sort of pinnacle or euphoric kind of feel, or is this just what makes sense, has been on hold for the past 3 years as people remained on the sidelines?
Idiosyncratic gets thrown around a lot, but I'd say this is another data point in a long list of data points that you've just gone through about where markets are right now. The door is wide open for deal making, and if anything, this Fed's about to juice things even further with rate reductions.
So it goes to this conundrum that Stephen Myron tried to parse out, the idea of financial conditions being conflated with Fed monetary policy. A lot of people could argue, myself included, depending on what hat I'm wearing, that if you do cut rates, that would be easing financial conditions at a time where the financial conditions already are incredibly easy. Other people might say, well, there are different sets of factors with those leveraged buyouts that might be reasonable and have nothing to do with Fed policy. Nonetheless, you can imagine if the Fed cuts rates, it will only encourage more of this.
Let's take the Max Kettler argument over at HSBC. Max is super bullish if you didn't know. Max is essentially saying that there are things that matter to the equity market and things that matter to the Federal Reserve. And the things that matter to the equity market are pretty good right now. Big tech's doing okay, printing money, earning loads, stocks are higher, fantastic. The things that matter to the Fed, not so great right now. Labour market's seen a real step down in payrolls growth. They're the kind of things that make the Fed nervous. They got to respond to it. So as far as he's concerned, the market gets the best of both worlds. Gets the profit profile of the big tech players, or the S&P 500. Also gets the rate cuts from the Federal Reserve as they respond to nervousness about the labour market. And in his view, you get the asset price inflation that he wants to be on top of. That's the train he wants to ride.
My issue with that, and I think that you're right, I think a lot of people would agree with that, which is the reason why you're seeing upgrades from Goldman Sachs, from BMO, from others. The only issue from that is if you have a hammer, everything is a nail. And for the Federal Reserve, they might be trying to solve a problem with the wrong tools. And that might be the asset price bubble. And he was saying he does think it's going to be a policy mistake. I'm talking about Max Kettler now. But it doesn't mean you shouldn't go along for the ride, which is what a lot of people are saying.
Guess what stocks are doing this morning? Up again, up by 0.5% on the S&P 500. Coming up this hour, Jonathan Goldman of Seaport Global as stocks trade near all-time highs. We'll catch up with Brent Thill of Jefferies on why he thinks the US TikTok deal is massively undervalued. And Lindsay Piegza of Stifel as investors await the latest payroll data later this week. We begin this hour with stocks edging higher as bullishness in tech stocks continues to grow. Jonathan Goldman of Seaport Global writing consensus narrative holds that irrational exuberance towards AI is the driving force behind the success of tech. The data contradicts those assertions, pointing to superior earnings. Jonathan joins us now for more. Jonathan, good morning.
Morning.
And congratulations, sir. You're an old friend, and it's great to see you in a new seat.
Yeah, I mean, I could not be more excited about Seaport. It's just this really cool, small boutique research shop, and 30 fantastic senior analysts. It's really great to be part of it.
It's cool to get the opportunity to catch up with you first right here on Bloomberg. So let's talk about your recent views. You've heard the term irrational exuberance back in the 90s. It's on repeat. Here we are in 2025. You think it's misplaced. Let's start with why.
Well, I mean, you take a look at, let's say, the third quarter earnings outlook, the big tech companies are just keep ratcheting, the expectations just keep ratcheting higher and higher. These are not stories where valuations are going up because investors are exuberant. The investor class keeps underestimating how good the earnings picture is. They crushed earnings during the last earnings season. The estimates on these names keeps getting pushed higher. And the stock prices are not higher in valuations on big tech. They're flat for the year. And the reason is because the earnings are driving the superior results.
Can you say the same thing about the rest of the S&P 500?
No, I mean, it's kind of a strange thing that if you actually say, well, what's expensive, the rest of the market is not being driven by earnings and it's being driven by valuations. I would argue that investors around the world are getting sucked into the U.S. market because of great tech earnings. And then what are they, and then you buy this larger basket and the valuations are going up on the non-tech part of the market. And the tech stuff seems incredibly healthy.
So it's the Magnificent Six. That's what you're arguing for, that should be what people invest in. Who gets kicked out of the Magnificent Seven?
Well, first of all, I don't consider Tesla a tech stock. So I don't include it, not because it's not a wonderful company, but it's just not part of it. But I don't think we should be looking at these companies and saying, they're doing really well, let's create an acronym and just kind of shove their name in and then we switch again. This is what
Wall Street does.
No, but it's silly. I mean, there are 6 huge tech companies that are growing at this unbelievable pace, at these very high profit margins. And here's the key. The stock prices are following the earnings growth of these companies. They're the biggest 6. It's not like we can listen. You and I can go and if we want to come up with an acronym, we can throw Oracle in there and say great returns, and let's throw Palantir in there, and we'll sit there with the Scrabble board. Yeah. That's not what it's about. It's like these are the big names, and they're big not because we fell in love with them. They're big because they're just out earning everything.
So at a certain point, are you saying that you could see gains driven by the magnificent whatever, by big tech stocks, and at the same time, you end up with the rest of the index falling further behind, and that equal weight, which everyone has been trying to go to, actually underperforming yet again for another year?
Probably will. No, yeah, I mean, and if you take a look at, let's say, for example, the S&P X the Big Six, and then you look at global equities, they kind of look the same. The non-U.S. basket and the U.S. basket X these 6 companies, they sort of feel alike. I mean, I've talked to global investors recently who are kind of doing a barbell. That, in their global portfolio, they're buying these companies that you can only get in the U.S., and in the rest of the portfolio, they're putting their dollars in other sectors abroad, and that's how they're coming up with their balance.
Is that
it makes sense?
Diversify the exchange rate diversification story, the exposure to the US dollar? What is that about? Is it just about getting exposure to the European bank rally? What's the diversification abroad about?
Well, first of all, if you look at the outperformance we've had year to date of non-U.S., it's nothing but a currency issue. So the underlying earnings are still better in the U.S. and the like. But if you're running a global equity fund, you feel compelled to have similar, weights to the benchmark. So if you want to grab all of this exposure in these big tech numbers in the U.S., so you buy a consumer staple company in Europe because, a consumer staple company in Europe kind of feels like a U.S. consumer staple company.
Do you have questions about U.S. equity market exceptionalism? Do you have any questions about that at all?
I mean, not right now. I mean, there's a ton of reasons why, over the long run, the U.S. should do better. I mean, we have, if you look at the venture capital industry, which has embedded itself in our universities, and the fact that it's not a surprise that not only the top 6, but if you look at the suite of the top 20 tech companies, the vast majority of them are in the U.S. There's something about the operating environment that we have here that is, that creates.
John, I would also say the deep pool of risk-seeking capital. I remember Jeff Bezos came out and talked about the secret sauce of the American economy. It's the fact that you can raise $50 billion just like that, for something that may or may not succeed. And we've seen something else like that again this morning with another deal announced. These are the kind of deals that you would only see in America. You wouldn't see a deal like that elsewhere this morning.
Yeah, although some people might say that that's the folly potentially of the market cycle too, which is one thing that people will, potentially.
I just want to jump in on something you said.
Please.
The liquidity on U.S. companies is just much better. Part of it is that there's more regular reporting in the U.S. with quarterly reporting. Rather, I don't mean to be a high point on that.
Hey, John, you've gone there. So let's talk about it. No, you touched it.
But there's a whole bunch of reasons why when non-U.S. companies re-domicile into the U.S., their stock prices go, and it's not just simply because people are chasing them. It's the U.S. market is deeper, it's more liquid, and
are we putting it at risk? Are we putting it at risk? You talked about quarterly reporting. You're alluding to changes we might see from the SEC. Are we putting some of that at risk?
Well, there's a really simple bottom line on this. Investors want transparency. If the government says you only need to report every 6 months, large companies are going to who go to semi-annual reporting, whether it's voluntarily or required. If they move to semi-annual, their stock prices are going to go down because they're providing less liquidity. They will voluntarily report quarterly because someone is going to tell the board, rightly, if you do not provide transparency, your stock price is going to sell at a lower price, and they are not going to do that.
We've had an entire conversation about U.S. equities without talking about the Fed. Is that just not even on your radar?
It's first. Let's look at what I think the biggest issue, because you talked about if they don't get this incremental information, are they go? What are they? What are they going to do? The bottom line is that the market expects another 4 cuts between now and the end of 26. And so we need to kind of extend the horizon. The Fed is going to be friendly to capital markets over the next, year plus. And whether or not we're talking about what the makeup of the Fed is or what they do in the next 2 meetings, it really doesn't matter. What really is driving the market from a credit point of view, the market is like 5 times more sensitive to high yield spreads. And you talked about, one of you talked about financial conditions. If you look at the Chicago Fed's measure of financial conditions, if you look at the St. Louis Fed's measure of financial conditions, you have an environment where liquidity is plentiful, the market is operating well, and I totally agree with your when you're talking about Max, I think it was before.
Sure.
And the things that the Fed sees is they don't have a growth and inflation mandate. They have a jobs and inflation mandate. So the Fed is reading a weak jobs environment, and they need to do. And you talked about it a second ago. They only have one tool, and it's a big hammer, But so they're gonna feel compelled. According to the Bloomberg survey, 50,000 jobs are going to be created this month, whether we get the report on that or not. More than 50,000 people enter the labor market. You could argue that this means the labor market's moving back. The Fed has to act in response to that, and yet you have financial conditions are great, GDP is strong, and the backdrop for stocks is really liquid.
The pain trade's higher? Is that what you're expecting?
What was that?
The pain trade just continues to be higher.
Yeah, and I think that folks who are fighting, it's not just fighting the tape and people adjusting their numbers because their targets are too far behind the market. That's not the story. The earnings are coming through. The market's expecting somewhere between like 11 and 14% earnings growth for each of the next 3 years. We're like super conservative, and we're expecting high single digits, and that's a big haircut compared to the consensus.
Jonathan, it's good to see you.
Good to be here.
Thank you, sir. It's nice to have you back in action. Jonathan Golub there of Seaport Global. Your equity market right now up by 0.5%. That is a major go-private deal announced about 10 minutes ago.
Yeah, Electronic Arts with a potential price tag that's 25% premium, raising questions about what that means for financial conditions, how loose they are, how loose they can get if the Federal Reserve cuts rates further.
That stock is higher so far this morning. That will start trading again going into the opening bell, I imagine. 210 is the per share agreement with a range of companies this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump said the government is likely to shut down unless Democrats back down from their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The top 4 congressional leaders will meet with the president today at the White House, just a day before funding is set to run out. And as you all were just discussing, video game maker Electronic Arts is going private. The deal values the company at $55 billion. That's the largest leverage buyout on record. The consortium, which includes Silver Lake Management, Saudi Arabia's Public Investment Fund, and Jared Kushner's Affinity Partners, agreed to pay $210 per share in cash. And President Donald Trump has ordered his administration to declassify and release all government records related to Amelia Earhart, her final trip, and everything else about her. Earhart vanished during her groundbreaking flight around the world, one of aviation's greatest mysteries. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next, the Morning Calls Plus. We'll catch up with Ed Ludlow on the deal to keep TikTok in the United States.
Rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. The reality is the opportunity in terms of global fixed income is very, very big, and the opportunity to add alpha is quite high.
Triple espresso. PIMCO CEO Manny Roman. That's how he wakes up.
Yeah.
At 3 a.m. on the West Coast.
Well, I should take that under consideration.
Yeah, ditto.
I try 4.
Is that what you do?
No, I can't. I'd be shaking. And you'd make fun of me, and I'd say
Probably,
things like
yeah.
Courtney,
That's,
Contrarian Courtney.
That's what you said a little bit earlier, yeah.
I mean, that's what happens when you have
In case you missed it. What are we now? Contrarian Courtney. Okay. Struggling to keep up with you this morning. A rare catch-up with Manny Roman. Great to hear from him, as always. Equity futures on the S&P 500. Positive here by 0.5. On the Nasdaq up by 0.6. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Wells Fargo to equal weight, noting the key catalyst of asset cap removal has passed, limiting upside. That stock is down by a third. Your second call from Wells Fargo downgrading Western Alliance to underweight, saying it won't benefit from interest rate cuts until next year. That stock is down by 1.4%. And finally, Deutsche Bank raising its price target on Intel to 30, applauding steps taken to bolster its balance sheet. The stock is negative here by 1.5% after a major rally over the last few weeks. That's some of these single names, some of the morning calls. Let's stick with tech. President Donald Trump signing an executive order advancing a proposal that would allow TikTok to continue operating in the US, but the details still remain somewhat elusive. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome back to the program, buddy. What's the latest for this deal?
Yeah, I think the latest is a scramble across Washington, D.C. and the investor base to understand if the structure of this deal, which a source phoned me Friday night to read me from the piece of paper, is compliant with the 2024 divestment law. I defer to AMH on kind of the broader which trumps, pardon the pun it, a congressional mandated piece of legislation or an executive order. But basically, ByteDance having 19.9% in the US-only entity maintains the status quo that it still has some broader majority ownership of the global entity and operational or profit-sharing control. And it's hard, based on the conversations I'm having, for those participants to see how it does comply with last year's piece of rulemaking.
Ed Ludlow with the latest. Ed, looking forward to the show a little bit later this morning with Caroline Hyde, Bloomberg Technology, in about 3 hours' time. Want to extend this conversation with Brent Thill of Jefferies, calling the TikTok deal potentially massively undervalued. Brent, welcome back to the programme. Can we put a number on these things? Just what are these companies paying for this asset, and how does that compare to valuations elsewhere?
Yeah, I mean, it's hard to see because the details at $14 billion, when you think about, half the profits going back, what are all the details underlying? We don't have the full list, but I think the initial figure was massively undervalued. Was that giving, the U.S. and the new owners an opportunity to have some great upside in terms of the equity value? But I think anyway, you look at it, looked undervalued. Again, we don't know the profit sharing agreement, but when you think about other companies in the social space, when you look at Meta, the rest of the complex, you look at other comparable tech names, it looks, even if they were doing a profit share, it still looks undervalued in our opinion.
Brent, what do you think the ramifications of that are? You think that it's to give a better deal to other people? What's the significance of this for understanding the competitive dynamics of this particular entity as a more U.S.-owned one?
Yeah, I think for the biggest competitor is obviously Meta. We think that no one's going to leave Instagram because now TikTok's up. You look at most of the younger audience, including my older friends, they're between Instagram and TikTok. And then Snap is really a messaging platform for the younger audience, and they're not influenced by any of the campaigns that they run. So there's really not been a lot of advertiser opportunity because the younger audience use it as a messaging tool so the parents can't see their messages, and that's about it. And so the real ramifications really just socially against Meta, and Meta's continued success has been so great in the lock-in and the technology advancements. So we don't believe that advertisers are going to stampede away from Meta. We do think that ultimately, because the stability of the asset will create potentially more excitement for advertisers to potentially come back for those that may be left because there was some distraction going on through this process. So I don't expect, a massive shift in spend. I don't expect a massive loss of advertisers from Instagram, but I think that calming the situation down does help advertisers come back. And then the question becomes, how innovative is the platform going to get now versus where it was at before? And so I think there's a ton of innovation, there's a ton of excitement, but ultimately I think all three platforms serve a different purpose, and most users are going to those three. I don't think consumers can take a fourth and a fifth. I think we've been working through this the last couple of years with how many can we consume, and right now we're seeing, I think, those three work with each other, and they work in different ways. Snap for comm, Instagram for more professional content, TikTok for more fun content, and you're seeing kind of a in between and hey, I'm getting bored with this platform. Let's go over here. I need to send a message to my buddy. Let's send it here. So I don't think there's going to be any massive changes from what we can see so far, unless there's some massive level of pickup and innovation. We just don't see that. We see Meta actually moving forward, and Zuck mentioning, there's 3 billion people plus on the Instagram platform. I think it speaks to how good that platform is, how good the targeting is.
Yeah.
And the advertisers, all the checks we do, they've been gaining market share against others. So even if, again, assume TikTok is successful in terms of some new innovation, I think it's going to come from other places. I don't think it's going to come from the Meta or Instagram budgets.
Brent, I've got 30 seconds left. Just quickly, just announced the largest leveraged buyout on record, Electronic Arts. I think a long, long time ago, you used to cover this name. What does this make you think? What's your response in 25, 30 seconds, if you can, about the amount of money just sloshing around?
Tech M&A is booming. Tech M&A is going to massively pick up. It has already. We've already seen, companies like Atlassian, and you've seen Workday do, multiple billion-dollar deals just in a month. So, M&A is up in a massive way. You're going to see a lot more, and I think you're going to see bigger deals. We've heard, even companies like IBM say that they can't do deals, over 10 billion. They've taken that away. They've said we can do much bigger deals under this administration. So this is a taste of what I think you're going to continue to see.
Brent, appreciate it. Thank you, sir. Brent Thill of Jefferies on TikTok, and this deal for Electronic Arts, a mega deal this morning.
Yeah, and more to come, as he says. I just want to say, I hope that the next innovation, at least for the kids out there, is pick up a book, read a book. That's a new platform. I think they're good.
I hope that's a new innovation too, but I don't think that's happening. I think that stock's resumed trading. We're up in the pre-market by about 5%. Live from New York City, you're watching Bloomberg TV. Equity futures still positive here by 0.5% on the S&P 500, up 0.6 on the Nasdaq. Got some Fed speak for you. The Cleveland Fed President Beth Hammer coming out on the hawkish side, as you'd expect. Need to maintain restrictive policy. Inflation expectations concern me most now. That is just the polar opposite of the other side of the spectrum, which is Governor Myron, who is more concerned about the labor market than he is inflation.
And more people seem to be coalescing around prioritizing the labor market. That said, the fact that the Beth Hammocks of the world, Raphael Bostic, has come out in the same kind of place. Even Austin Goolsbee said he needs to really hold off for a bit. He isn't happy of front-loading rate cuts. Raises a question about whether the bar is getting a little bit higher for the Fed to cut beyond maybe another 25 basis points or 50 this year.
Range of views is getting wider.
It's getting wider.
Not narrower, it's getting wider. Into a big week full of Fed speak and economic data. In the bond market, yields down across the board on 2s, on 10s. The 10-year down by 2 basis points to 4.15. 2s at 3.63, down about a basis point this morning. For now, though, we need to get you some single names because this morning a massive story. The largest leveraged buyout on record. With the details, here's Danny. Hey, Danny.
John, the price tag, $55 billion to take Electronic Arts private. It's going to be led by the Saudis, PIF, by Jared Kushner's firm, Affinity, as well as Silver Lake. The deal is also buying the shares out at $210 a share, so we're not even quite at those levels yet. 5.6% is the rally that we're seeing pre-market. By the way, the high watermark that this beats of the last big leverage buyout was a company called TXU. It was a Texas utility company in 2007 that went on to declare bankruptcy and lost its buyers a whole lot of money. Make of that what you will. Some other deal news to work through this morning. This one coming from the FT, that Occidental Petroleum is looking at selling off OxyChem. It's their petrochemical unit. It would be for $10 billion. Should that deal go through, it would help Occidental pay down some of its debt, which it has been doing through asset sales. Finally, this morning, we're also looking at the defense companies rallying. Lockheed Martin up 2.1%, RTX up 2.3%. This follows a Wall Street Journal story in the early hours of this morning saying that the Pentagon is asking the defense contractors to double or even quadruple in some cases their manufacturing of missiles. They say the stockpile is too low should there be a potential conflict with China. John?
Danny, thank you. Appreciate it. Thank you very much. 3 of the single names and more to look out for going into the opening bell in about an hour from now. 10 is the economy. We're waiting for payrolls on Friday and wondering if we'll even get the jobs report. Joining us now to discuss is Bloomberg's Enda Curran. Enda, welcome to the programme, sir. I think we've got to address the elephant in the room. Before we talk about all this, what it means for the Federal Reserve, the data this week, will we even get the jobs report on Friday?
Well, that's the critical question now, the big unknown, Jonathan. If the government shuts down tomorrow night, in truth, most economists think it's unlikely that they would be reopened, a deal would be reached in time for Friday for the data to be released. So there is now a question mark over whether or not we do get the jobs data Friday due to the government shutdown negotiations. Bigger picture then, that doesn't just mean a delay for the September data. It feeds into the whole narrative and story around the quality of the jobs data and broader data anyway, when there are enough questions and doubts already circulating in the market about that. And then throw into the mix, of course, what does it mean for other highly sensitive data readings like inflation numbers, the gathering and collection and eventual release of all of that. So a lot will depend, of course, if the government does shut down, then how long the government does shut down for. But at the very least, big question mark now over whether we get the jobs data or not.
So, Enda, as Lisa identified a little bit earlier, we have to basically refer on some of the private indicators that we get. ADP will be looking out for the ISMs as well later this week. Enda, what kind of a picture do you have for the economy at the moment? And just how divided is the Federal Reserve? We were talking about it just months ago. It just feels like at the moment, differences are getting wider, not narrower on the FOMC.
It doesn't seem to be a binary story on either the economy or the FOMC, Jonathan, right now, like you mentioned. I mean, on the one hand, of course, we've had this big shift in the jobs data. Clearly, labour market weaker than expected. The Fed, of course, putting all focus on that now. It's kind of a consistent thread there. But, you know, we also had much stronger than expected third quarter growth. Consumer spending on the retail side still holding up pretty well. We'll get consumer confidence this week. That's expected to show kind of a rebound in the month of September. So you have this kind of picture where the economy is still holding up even as the jobs market weakens. Now, of course, if we were to get that data at the end of the week, it's expected to show around 50,000 odd jobs created last month. But there would be a lot of scrutiny in terms of where those jobs being made and lost. And in particular, the manufacturing sector, politically hot. Is that turning around? Any signs of a turnaround there? Are we seeing any signs of the federal job cuts starting to leak through to the jobs data yet? So, as I mentioned, headline growth, aggregate data on the economy okay, but the underlying jobs numbers are expected to continue softening for sure.
Enda, thank you, sir. Appreciate it. Enda, with the latest down in Washington, D.C., got a widespread of opinions on the FOMC right now. So that means someone could be very right and someone could be very, very wrong at the Federal Reserve. And someone on this committee, many, could be caught really offside into 26.
You know, the big question, I think, for markets is what Manny Roman was talking about of PIMCO, how much you have faith in the members to ultimately be swayed by the data that comes in because they don't know that much more than the market knows. And ultimately, if there is a hot print, what inflation print in particular, how much do they respond to that with either stopping some of the rate cuts or even possibly putting a rate hike on the table? That is the unknown, especially given what Stephen Myron was talking about, which is targeting a neutral rate that he sees as lower and expecting the data to follow suit.
That's the bear case. 22, you go into 22 and you're thinking inflation's transitory, and then you get absolutely hammered by rate hikes and a Federal Reserve that has to pivot. You go into 26, worried about downside risk to the labour market. You're talking about inflation as if it's transitory. Do you get hammered by a Fed that has to pivot again? That's the bearish case. How credible it is right now with other people, I don't know. But ultimately, that's the story.
And will the Fed be willing to do that? Right. I mean, ultimately, right now, this is not a market that believes that the independence of the Fed has been compromised. You can see that in the inflation break-evens. You can see that in a whole host of other metrics. If that gets to be the case, then all of a sudden you have a different story. And I think that that is the test. What happens and what is the reaction function when you do get an inflation print that comes in hot?
Let's talk to someone about it. Lindsay Piegza of Stifel joins us now for more. Lindsay, welcome to the programme. You've criticised the Fed in the past for stopping short of being sufficiently restrictive. You think they eased too early last year as well. What mistake are they making now?
I think they're doing another round of precautionary easing in anticipation of this weakness, this fear of weakness in the labor market, rather than focusing on the problem that's right in front of them, which is still too elevated inflation, as it has been for years now. So I am concerned that the focus is beginning to shift away from inflation just at a time when the risks to inflation remain to the upside. As we look towards the end of the year, we could see hotter price pressures amid a stronger growth profile, a more spendy consumer as we move into that key holiday spending season, or as we turn the corner into next year and corporations find they need to pass along more of these cost increases onto the consumer that were previously absorbed into the bottom line. So right now, I think the Fed would be well advised to take a very cautious, patient approach, watching the data as it evolves and respond to the data, as opposed to anticipatory, reactionary easing as they have been for fear of, that labor market weakness.
Neil Dutta over at RenMac has been throwing things at the computer screen, or however he watches this show, as he listens to this, and he says, ultimately, how much can you have a reacceleration without the participation of the housing market? You can look at all of these metrics and raise questions about it, but because housing is flat on its back and is actually contributing to disinflation, isn't that an argument to sort of squelch some of the inflation worriers?
I don't know if we can make that specific argument and isolate it to that degree. Right now, we're looking at the consumer data. Consumer is the backbone of the economy. So independent of housing, if the consumer is out in the marketplace spending on goods and services, because there still is a good amount of spending and borrowing power on part of the household balance sheet, I think we can continue to see at least these 2%-ish growth rates for quite some time, which will continue to perpetuate this still elevated inflation. So again, it goes back to the fact that the Fed did not do their job the first time around. They compounded that mistake, that policy mistake, by easing last year. And now it appears that they're willing to do a third round error with that September rate cut, and still a number of Fed officials talking about additional easing by this time next year.
So, Lindsay, why do you think the yield curve is flattening?
Well, I think right now the market is buying into the notion that the Fed will provide easier policy, and the market seems to be focused on other issues than inflation. But that's not the only metric of what we're seeing in terms of investors' concerns. When we look at inflation expectations, we see that near-term inflation expectations are still up near 5%. Longer-term inflation expectations up near 4%. So even with the Fed continuing to reiterate a focus on reinstating price stability, the market isn't buying it. Now, the yield curve, yes, we have seen a lot of volatility, but a longer base trend should continue to provide a floor to longer term rates, given those inflation expectations, not to mention the massive expansion of the balance sheet.
And yet, Lindsay, that's not constraining the Federal Reserve. In fact, they continue to signal interest rate reductions. Now, you and I have played this game a million times. We can complain about what the Fed should and shouldn't do. It's the will-won't that really matters to financial markets. What do you think they will do?
Well, I think right now, when you look at these varying opinions of the Federal Reserve officials, I think they are going to, at least in the near term, stay pat. They gave us that insurance rate cut in September earlier this month. But when we look out to the end of the year, unless we see a material decline, further decline in some of those jobs numbers justifying additional policy adjustments, I think the Fed is going to have to stay steady where we are. Now, that being said, the inflation hawks, they're looking for policy to maybe even move move firmer unless we see a material uptick in inflation, not just a temporary few tenths of a percentage point, but a sustained upward trend in inflation. I think it's going to be difficult to justify a rate hike on the other side. So I think right now the Fed is more in a position to let's hold steady, watch the data, and both of the sides, the doves and the hawks, can fight it out over what we see the data evolve into.
Lindsay, appreciate it. Lindsay Piegza there of Stifel with the latest. I think those doves and those hawks will continue to fight it out next month.
Yeah, I wonder what that fight looks like. Very polite. I don't agree with you.
I'd say Governor Myron actually was pretty diplomatic when we asked him, wasn't he? About his experience going into the committee, the need to persuade people, how open they were to his views?
I think he was being honest. I don't think anyone gave him odd looks or refused to sit next to him. And I think people were actually welcoming contrarian views that they could push back on. It was clear that nobody was particularly convinced, but he is representing something that people on Wall Street are talking about. The big difference, and he talked about this in his conversation with us, is just the speed. How quickly do you need to get to the ultimate destination for the Federal Reserve? And that really is based on what you see in the economy and what you see evolving.
What you think neutral is.
Exactly.
That debate's ongoing because no one really knows what neutral is. Someone else joked about this, it's not my line, but they thought it was pretty curious that people were insulting Governor Myron about where he thinks neutral is because neutral can't be observed, and they keep saying that things are okay as they are because we're close to neutral, but neutral can't be observed. It's a very circular argument where you find yourself in a tricky position when you criticise others.
Who's on first? Who's on first? I mean, this whole thing, it's a very difficult moment, especially when you're talking about these theoretical concepts that don't really exist.
You can't observe any of this. Apart from in real time, you can say, we're neither sort of, whatever. Bond yields are lower by 2 basis points, 4.15 on a 10-year this morning. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Video game maker Electronic Arts is going private. The deal values the company at $55 billion. That's the largest leveraged buyout on record. The consortium, which includes Silver Lake Management, Saudi Arabia's Public Investment Fund, and Jared Kushner's affinity partners, agreed to pay $210 per share in cash. Shares are higher, 5.3%. Meanwhile, President Trump is warning the government is likely to shut down unless Democrats ease their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The president is set to meet with the top 4 congressional leaders at the White House today, just one day before federal funding runs out. And New York City Mayor Eric Adams has ended his re-election bid. The announcement follows reports that Adams was entertaining potential job offers from the Trump administration and the private sector. That's in exchange for bowing out of the race to allow former New York Governor Andrew Cuomo to challenge Democratic nominee Zohran Mamdani. That's Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Thanks very much for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Jim Karen of Morgan Stanley. Looking forward to that conversation on why the money will have to stay easy for longer than you think and what it means for asset prices. Jim's up next.
The big tech companies are just keep ratcheting, the expectations just keep ratcheting higher and higher. These are not stories where valuations are going up because investors are exuberant. The investor class keeps underestimating how good the earnings picture is. Earnings are driving the superior results.
Good to catch up again with Jonathan Golub of Seaport Global, constructive on the earnings story in the equity market. Equity futures so far this morning up by 0.5% on the S&P, higher by 0.7 on the Nasdaq 100 as we count you down to the opening bell. A few things to look out for later on this afternoon and through the trading week. Today at 3 p.m. Eastern Time, the President meeting with congressional leaders. Look out for that because tomorrow government funding runs out. Then on Wednesday, PMI and ADP data, the data points to look out for. ISM's in the mix too going through the week. On Thursday, another round of claims. And on Friday, maybe the payrolls report. We'll see if we get that. The payrolls report is due on Friday. Let's turn to fixed income. Treasury yields ended the week at their highest levels in a month as investors shift focus to Friday's jobs report. Joining us now to discuss is Jim Karen of Morgan Stanley. Jim, good morning.
Good morning.
We just had the biggest leverage buyout deal in history announced earlier on this morning. And in your note, you said this: there is something deeper at work that may keep easy policy at work for longer. There's a lot of money sloshing around, and you think money can stay easy for longer. Why is that?
Yeah, thank you. Look, I think there are a couple of other things at work here, right? So let's talk about monetary policy and fiscal policy. Those are the two policies I'm looking at. On a monetary policy perspective, the one thing that's happening is that as the balance sheet is shrinking, that is effectively a tightening of policy that's creating some potential for liquidity issues in the markets. That's measured by overnight repo rates, which have been going up, which is a sign that bank reserves have been under a little bit of pressure. So the Fed may not just be cutting interest rates to have an insurance cut for the jobs market, but it could also be there to try to stave off any type of liquidity issues. The second point is on fiscal policy. Fiscal policy, I believe there's a geopolitical need or desire to have coercive policy between whether it's tariffs or a strong economy driven by tariff-related policy in order to fund fiscal and geopolitical, policies throughout the U.S. in terms of what their objectives are. So my bottom line here is that there are other things at work on the geopolitical side and on the balance sheet side that could keep the policymakers at it for longer, despite what the economic numbers are telling us.
Can you have your cake and eat it too? This idea that everything is easing, you're going to just have an extra boost to markets. It doesn't seem like people are worried about inflation. Where's the rub?
That's the rub. It's inflation. As long as you don't get inflation, then you can keep doing this for a bit longer. But eventually, obviously, these things come to an end. So what is happening right now, as far as some of this fiscal policy, this is tax policy, accelerated depreciation, this is all in the One Big Beautiful Bill Act and what have you. What that's likely to do is generate higher productivity, which means you can have higher growth with lower inflationary burdens. Your typical way of thinking about the economy is that you get stronger growth, and that leads to higher inflation. But what's happening is that the unemployment rate is staying relatively low, but there's fear that it may actually start to come up. We're seeing that in the numbers. The labor numbers, we're going to see some more on Friday and Wednesday, are actually showing some signs of weakness, which means that you're getting labor at a reasonable price. There's enough. The labor force participation rate has been going up despite almost zero immigration. So people are entering into the workforce. That's keeping labor costs relatively low. If you keep wage inflation down, then you keep consumer inflation down. That can increase profit margins, and that can be supportive for equities broadly.
Another way of putting this is the way that one person framed it to me, is do you need to run the economy incredibly hot in order to make it so that a lot of people don't lose their jobs to AI?
That is the underlying story. That is exactly right. And that will continue to happen until there's high wage inflation that ends up leading to high goods inflation, and then the Fed has to then act and start to tighten policy, which that's not the move that they're doing right now. They're likely to cut rates another 3 times. But that is exactly right. You have to run the economy hotter, and you can as long as you don't get the adverse inflationary impact. So for everybody investing in equity markets and what have you, this is actually a reasonably interesting time, and you can see that in today's futures prices.
Does that depend on who leads the Fed?
I think it does. It does to a degree, but the productivity boost and the boom and the CapEx cycle, a lot of this is really coming from the fiscal policy side. A lot of that's coming from the tax accelerated depreciation and a lot of the tax policies. It does depend on who's leading the Fed. But I don't think that I don't think we're overly reliant on that, because if the inflation numbers come low, their models are pretty hard-coded. They don't have to worry about it.
Even if inflation spikes, I'm just wondering, will we have a willing partner in the Federal Reserve just to let this rip?
Yeah, so if inflation spikes, I think no. I think that everybody will line up, because inflation, whether it's political or it's economical, inflation is something that nobody has any patience for whatsoever. And I think the Fed, even though people might say it's become more political, will pivot on that. Inflation is the one thing everybody feels all the time.
I'm just thinking about Richard Fisher's speech back from the Dallas Fed, where he was talking about beer goggles, where if you're at a party and you're a little bit, had
Tell
a few,
us more, Bramo.
that everything looks good to you. I just wonder how much people are getting ahead of themselves with respect to long-term investments that project out growth over the next 10 years. And we have no clue. We have no clue about a lot of these industries and how they're going to evolve. We have no clue with video game creation and whether people are going to invest so much to play this particular game or that particular game. How do you price this out?
Okay, so I think the best way to do this is to go back in periods of time in history and think about, forward-looking elements to this. What we are going through today is a CapEx cycle. For the last 25 years, we've really had a housing-led economy. Housing is not the big driver of growth and investment right now. It's a very big part of the economy, don't get me wrong. But we are in a CapEx-led cycle. The last time we saw this was about 30 years ago. It was in the mid-1990s. That CapEx-led cycle brings manufacturing, brings higher quality jobs, you get higher productivity, you get more profitability, and what you end up getting is the big one, higher potential growth. That's what a big CapEx cycle it does, and I don't think that people fully appreciate that because, it was 25, 30 years ago.
I guess I'm just thinking about this EA deal, which I know you don't want to comment on. But the idea of, The Sims or Call of Duty, and that we can
dance around it.
Put a value around some of these things 10 years out when people aren't playing some of these more expensive games and they're actually on their phones. I mean, how do you understand how much money is going to be lost in this process?
So the way that I think that most people going into any type of an investment deal think about it is they always think about the discount rate. That's why interest rates matter so much. If you believe that interest rates are going to be lower than ordinary in this type of a relative to the amount of growth that we're potentially going to get, then that means you're buying things at a cheaper valuation because you're discounting those cash flows at a lower rate, which gives you a higher present value. So it really depends on your perspective. If you believe in this productivity cycle, this CapEx-led productivity cycle that gives you better growth with less inflation, or at least stable inflation, then you can actually value these companies and these opportunities at a higher valuation. And that gets back to what I was saying before, is that CapEx, higher productivity, supports higher valuations. So what may seem crazy maybe to us or to other people may not be, depending on how you're thinking about it.
Jim, smart. You always make me think, and it's good to catch up. It's good to see you. Thank you, sir.
Thank you. Good to see you.
Jim Karen and Morgan Stanley, thank you very much. And thanks to Lise for explaining what beer goggles are. Well, I felt like you were getting into dangerous territory there.
I think I did a really good job.
You did a fantastic job.
Thank you.
We're reflecting on the biggest leverage buyout on record. Electronic Arts agreeing to sell to a group of private investors in a deal that values this company at $55 billion.
Look,
it has been deal after deal after deal.
This is fascinating from so many points of view. First of all, the idea, does this indicate that we really are at a place where some of these deals can get unlocked, and this idea of M&A in the tech sector, also just the easy financial conditions, but also how do you value something? I mean, is Call of Duty even going to be popular in 2 years, or is everyone going to go back to reading books?
I'm not a video game kind of guy.
I think that you are.
And neither are you. So you and I are the worst people to comment on this story. From that dimension, from that angle.
Yeah, but I can advocate books.
True, I can do the same thing. This was a fun start to the week. The fun continues tomorrow. Will we get a payrolls report? From New York, you're watching Bloomberg TV.